Afternoon, everybody.
Good afternoon.
How are you, Commissioner?
I'm good. How are you?
I'm doing great, thanks.
How was your trip?
It was magical. It was really, really special.
That's great.
Yeah.
Glad I had a good time and got home safe.
Yep. It is. It's a long ways over there, that's for sure.
Yes, sir. Yeah, if you can't get in and drive by car, it's a little ways to go.
Yeah.
Good afternoon, Commissioner.
Good afternoon. How are you?
I'm doing well. How you been?
I'm busy, but pretty good. I can't complain. How about you?
Yeah, I guess the same thing. I would complain, but nobody wants to hear it.
Oh, I'll listen. It's getting hot where I live. How about you?
Yeah, July's coming. It's right around the corner.
Well, it's hot here, even though it's not July.
Yeah, the last 2 weeks of June are always, and then July, first 2 weeks of August, and then we're thankful for days under 90, which is crazy because anything over 80 is hot in my opinion.
Well, I understand. I can tolerate 80s fine. 90s, low 90s, okay. 100 gets to be pretty unpleasant.
I think it's supposed to hit 106 in Las Cruces this weekend.
Wow. Starting to sound like Phoenix temperatures, which are now 110 or something.
Right. There's a reason I don't live in Cruces. I spent 4 years down there. That was enough.
My parents used to live there and I'd visit them in the 90s, no, 80s. And now the weather here is like Las Cruces was then. Remember when it started to get hotter up here in Albuquerque, I was thinking, God, this is like Las Cruces, which I thought was the hottest place I'd ever been until I went to Phoenix.
All right, you meteorologists practicing without a license. Is the chairman going to kick our meeting off? He called me a few minutes ago. I missed his call.
I was just gonna jump in, Mr. Commissioner. This is Sarah, and he just called me. He's having some internet issues. So he asked if Commissioner Maestas could kick off the meeting and get it started, and he'll join as soon as he can.
You know, by the way, Sarah, you could tell him he could do like Commissioner Vicente Aguilar and use his phone. He could get on.
Yes, he's going to try to get on via the internet, but if he can't, he'll join by phone.
Yeah.
Well, if Commissioner Hall doesn't mind, I think I'll just kick off the meeting and then we'll see if our chairman.
Appropriate.
Just kidding. Good afternoon, everyone. Welcome to a regular open meeting of the New Mexico Public Regulation Commission. I'd like to call this meeting to order. Mike, please call the roll.
Commissioner Maestas.
Here.
Commissioner Byrd.
Here.
Commissioner Hall.
Present.
Commissioner Vicente Aguilar.
Here.
And Commissioner Fishman, still not here, but we do have a quorum of 4 commissioners.
Thank you, Mike. Commissioner Byrd, if you could lead us in the pledge of allegiance and the state pledge, por favor.
You bet. Thank you. I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all. I salute the flag of the state of New Mexico and the Zia symbol of perfect friendship among united cultures.
Thank you, Commissioner Byrd.
You're welcome.
Members of the commission, you have the agenda before you. Are there any changes or amendments to the agenda? If there are none, I'd like to entertain a motion to approve the agenda as presented. Any proposed changes? Okay, we have a motion by Commissioner Hall. Do I hear a second?
Second.
Second by Commissioner Byrd. Any discussion on the motion? Commissioner Vicente Aguilar. Okay, I thought you had a comment. All right, Mike Smith, Please call the roll.
Commissioner Vicente Aguilar,
Aye.
Commissioner Hall,
Aye.
Commissioner Byrd,
Aye.
Commissioner Maestas.
Aye.
The agenda is approved by a vote of 4-0.
Aye.
Oh, Commissioner Fishman shows up. I will take that as a fifth vote for an approval of 5-0.
Correct.
I'm hereby handing the gavel to our illustrious chairman. Take it away, Stephen.
Thank you, our illustrious, whatever they call you,
Vice
It's
Chair.
illustrious.
co-chair. Introduction of special guests. Anyone on the list?
I know Commissioner Byrd had an announcement for the Employee of the Month.
Okay, Commissioner Byrd.
Thank you. So obviously it's recognition of an employee that has done a great job for the PRC. I just want to say that at least myself, but I think I'll speak a little bit, hopefully for all our commissioners here. We really appreciate the hard work and effort being put out by all of our employees and staff. The dedication that we see is greatly appreciated. And so we take an opportunity at least once a month to point that out in a particular individual. And this month, I'm really happy to announce that Michael Smith is our Employee of the Month, and we have a resolution, and I will read it now. The New Mexico Public Regulation Commission hereby recognizes Michael Smith as the New Mexico PRC Employee of the Month for May 2021. Whereas Mr. Michael Smith serves as General Counsel with the Office of General Counsel Division of the New Mexico Public Regulation Commission, and whereas Michael Smith has worked for the PRC for 7 years, whereas his nomination states Michael Smith is a long-term dedicated employee. He is incredibly thorough and treats everyone with respect. Whereas Michael Smith continues to serve the PRC with dedication and great ability. Now, therefore, be it resolved that the New Mexico Public Regulation Commission of the state of New Mexico congratulates Michael Smith on his selection as Employee of the Month for May 2021. So congratulations, Mike. It's well-deserved, well-earned recognition. I personally really appreciate the work you put out, and I'll turn it back over to my fellow commissioners.
Commissioner Byrd, tell him about the special parking place he gets at the Para building.
Yeah, so it's down the street about 4 blocks over near the Roundhouse.
And it has a skull and crossbones on it. Is that the deal?
It's got a little blue symbol there.
Oh, okay.
Thanks. I'll make sure. Thank you very much. I'll make sure to take use of that. I've actually been there for 9 years. So does that mean I get 2 years of my life back?
Oh, you've been there for 9? Uh-oh.
Yeah.
That was a
Wow.
typo and it was
I guess he
corrected
only
in a
showed up
later
for
version.
7.
Sorry about that.
You'll have to consult with me about future nominees. I've got some good ones for you, I think.
I talked to Mr. Propst about that, and let's make sure we're recognizing employees that deserve it. The only downside here is that unlike our previous general counsel nominee, we don't get to take a picture with you and have you posted on your Facebook or your Zoom page.
The public will benefit from that absence.
Well, congratulations, Michael. You're so good. We're already thinking of more work to give you.
Right.
Thank
I
you.
was wondering what he did wrong.
Okay, we're going to go on to public comment. Sarah, any public comment?
I don't believe I have anyone for public comment right now or today. Thank you.
Okay, thank you, Sarah. Consent action item.
Mr. Chairman.
Yes, I'm sorry, Commissioner Vicente Aguilar.
Good afternoon, everyone. I just want to say congratulations to Michael Smith for doing a wonderful job. No one really articulated the job that you do. You're not afraid to tell me when I'm going to take a certain step, but I am not allowed to do that, or I'm going to run into problems if I take a certain action. During the open meetings, you're very watchful of what I say about certain cases, and you warn me before the meetings. You follow up after the meetings. I appreciate that very much. You keep me in line, and that's what a general counsel is supposed to do. The other part is last year or the year before, 2019, Judy Amer also received Employee of the Month. So I can say that we have the best attorneys working for us in General Counsel's office, not only for the lawyers that I just mentioned, but the whole team. There's new ones like Hans. He's wonderful as far as working on the cases and being very, inclusive about how it should be stated when it comes to presenting his cases. So I'm just very happy as well, Mr. Chairman. So I just wanted to state that. Thank you.
Thank you, Commissioner. And, all that stuff you said about Michael keeping us in line, it makes me want to withdraw the award, but it's too late now. Okay. And just kidding, obviously.
Sometimes there are hopeless.
I'm laughing.
Thank you, Jeff. At least somebody, gave me a little bit of affirmation there. We're on to, go ahead, Mike, you were saying something?
I was just saying that sometimes there are hopeless tasks.
Sometimes that seems like the only kind. So we're on to consent action items now. Commissioners have any discussion or motions?
Move to approve, Mr. Chair.
Do I have a
I'll
second?
second.
Second.
Okay, barring discussion, Mike, please call the roll.
I will have to read the not so voluminous number of consent action items first. The first case is an undocketed matter in the matter of the application of Clear Rate Communications, Inc. for a certificate of registration to provide competitive local exchange telecommunications service within the state of New Mexico. This is a potential order regarding application. The next case is 21-00127 UT in the matter of the verified petition of Tularosa Communications, Inc. as a competitive local exchange carrier for designation as an eligible telecommunications carrier for a limited purpose. This is a potential order appointing hearing examiner. Case 19-00200 UT in the matter of the formal complaint of Gary Echegaray and
Mike,
Leoberg.
That's
that's under regular action.
Oh, you're right. I'm sorry. I will withdraw that last one. 19-00200 is not part of the consent action items. I will take the
But
roll.
that's why you've been appointed Employee of the Month. You try to get these meetings done, and I appreciate that.
Sorry, my phone is dinging away on me here, and I'm trying to turn it off, and so I lost my spot. I'll call the roll. Commissioner Byrd.
Aye.
Commissioner Maestas.
Aye.
Commissioner Fishman.
Aye.
Commissioner Hall.
Aye.
Commissioner Vicente Aguilar.
Aye.
Commissioners, the 2 consent action items are approved by a vote of 5-0.
Terrific. We're on to regular action items. And first up is 19-200 in the matter of the formal complaint of Gary. And I.
Sugar Ray.
Pardon?
Gary Sugar Ray.
Sugar Ray. Okay. Thank you, Hans, for that help.
No problem.
Gary Echegaray and Leah Berg against Public Service Company of New Mexico. And Christopher and Hans.
Thank you, Commissioner Fishman. This matter comes before the commission on the recommended decision filed by hearing examiner Christopher Ryan on May 14th, 2021. On July 9th, 2019, complainants had filed a formal complaint against PNM and to which PNM answered to the formal complaint on August 5th. The complaint indicated that complainant's location was being serviced by 2 meters with a residential service rate for 1 meter and a non-residential rate for the other meter. The complaint alleged that the entire location should be serviced by 1 meter at the residential rate only. In response to the commission's order for a staff response filed on September 10th, 2019, the utility division staff filed 2 separate staff's verified response on September 18th, 2019. The commission appointed hearing examiner Christopher Ryan on June 24th, 2020. On March 5th and 26th, 2021, a public hearing was held before hearing examiner Ryan, to which hearing examiner Ryan then filed his recommended decision on March 12th, 2021. The recommended decision's decretal paragraphs recommends that the commission order as follows: that the complainant's formal complaint is dismissed, that complainants may, if they wish, modify their electric service and have 1 single meter providing service at rate 1A. If complainants notify PNM that they have made the necessary modifications to achieve this end, PNM will then promptly ensure complainants are serviced at the rate 1A. Within 30 days of the filing of the final order in this case, PNM shall submit a filing explaining the steps it took to determine whether the facts of this case warrant any changes in its internal complaint procedures relating to when and under what circumstances PNM CEAs will inform a complainant of their right to file an informal or formal complaint. The commission will review that document once filed and may or may not take further comment or action upon it. Any matters not specifically ruled on during the hearing or in this recommended decision is disposed of consistent with this recommended decision and the commissioner's rules, and that the docket is closed. As there have been no exceptions filed to the recommended decision, my proposed order then would have the commission adopt, approve, and accept the recommended decision in its entirety as prepared in the proposed order. However, I am deviating from the decretal paragraphs in so much as decretal paragraph E, closing the docket, will not occur until the filing required by PNM in decretal paragraph C. That is the only change to the decretal paragraphs that I recommend to the commission. With that, I would ask for a motion to move the order as proposed, or if any of the commissioners have any questions regarding more detail of the nature of the complaint, hearing examiner Ryan is here and available to review those with you.
So commissioners, questions, comments?
Mr. Chair?
Commissioner Hall.
Unless there's any discussion, I would like to move the order, given that there's no exceptions taken to the recommended decision.
And I will second it.
Thank you.
And just to
Commissioner
clarify,
Benson?
that's with the amendment to decretal paragraph E.
Yes.
Yes.
That is captured in my proposed order.
Okay, hearing no further discussion, Mike, would you please take the vote?
Commissioner Hall,
Aye.
Commissioner Maestas,
Aye.
Commissioner Vicente Aguilar,
Aye.
Commissioner Byrd,
Aye.
Commissioner Fishman.
Aye.
The proposed final order is approved by a vote of 5-0.
Thank you.
Thank you, Hans. On to item 4, docket 20-238, the matter of Southwestern Public Service Company's application for a revision of its retail rates, authorization and approval to abandon its Plant X Unit 3 generating station and other associated relief. Commissioner Maestas and Judy, please.
Mr.
Proceed.
Chairman, I'd like Judy to tee this up, and then if I need to follow up, I will, if that's okay.
Terrific.
Yes. Good afternoon, Chairman Fishman and members of the commission. This matter comes before you today upon the motion of Southwestern Public Service Company, SPS, dated May 28th, 2021, requesting that the commission grant an interlocutory appeal to review Chairman Fishman's third bench request order. That was issued on May 25th, 2021. SPS also asked the commission to issue an order rescinding the third bench request in whole or in the alternative in part. And 3, SPS requested the commission require Commissioner Fishman to provide an update under 1.2.3.9 NMAC related to the advice the commission may obtain in connection with a proceeding. In the alternative, on May 28th, SPS requested that if the commission didn't rescind the third bench request, that SPS be provided the opportunity to respond to the questions of the third bench request because it was initially directed to other parties. And SPS requested an opportunity to respond to the responses submitted by the other parties. Subsequently, on June 2nd, by single signature order, the commission did grant SPS's request to respond to the third bench request order and to respond to the responses submitted by other parties. Nevertheless, on June 4th, 2021, which was last Friday, SPS filed a motion to clarify the order for response and request for ruling, in which it stated that it did not completely understand the order for response, although it was clear that it allowed SPS the opportunity to respond to the questions and the responses submitted by the other parties. But the motion to clarify, I think, was filed to request a ruling on the interlocutory appeal, which is what the proposed order in your packet does at this time. So in that respect, the proposed order would be granting their request for a ruling. The proposed order denies the motion for interlocutory appeal, and I can go through the reasons. It grants SPS's request for an update pursuant to 1.2.3.9 in that it requires Commissioner Fishman to promptly file in the docket the name of the person consulted for advice and allow SPS the opportunity to respond to that filing. And if you would like me to, I can go through the order, which goes through all of SPS's argument about why the commission should rescind the third bench request in its entirety. But I recommend that the commission deny the request because commissioners have the right to ask questions that are relevant to the proceeding. And the ROE request for information are clearly relevant to the proceeding because in the application, SPS is requesting a particular return on equity. This does not mean that any of the answers to the third bench request will necessarily become part of the record because they are not automatically evidence. At the public hearing, SPS will have the opportunity to object to any of that information, and the hearing examiner will make a ruling on whether or not that would be admissible. So SPS's due process rights are protected by that. And I mean, SPS contended that SPS has a right to frame the issues, but as I stated previously, SPS presented this issue before the commission. So it is clearly reasonable for a commissioner to ask questions about ROE. And SPS argues that because a commission has assigned a hearing examiner to conduct a hearing and issue a recommended decision, that somehow that means that commissioners are not allowed to ask questions via mechanism for a bench request order. And that clearly is not true because commissioners are permitted to issue bench request orders in all cases where it has assigned a hearing examiner to conduct a hearing and issue a recommended decision. Hearing examiners are only work under the delegated authority from the commission, and the commission is allowed to limit that and ask questions. Another argument SPS made was that the bench request, the third bench request order in particular, are not questions but statements that take a position. The commission disagrees with that argument and finds that they are questions that seek to clarify issues and seek additional information. That the questions and answers are reasonably calculated to lead to admissible evidence. As I said previously, they're not necessarily admissible. That is another issue that will be determined at the hearing, and SPS will have the opportunity during the hearing on the rate case to have due process to object to the admission into evidence of any of the information discovered from the third bench request under Rule 1.2.2.25 NMPRC. For that reason, the proposed order denies the interlocutory appeal. The third bench request is not rescinded in whole or in part. And as I stated before, SPS has granted its request for Commissioner Fishman to file notice to the parties of the person consulted and the substance of advice, and to provide SPS a reasonable opportunity to respond. And I stand for questions.
Commissioner Maestas, anything that you want to add?
Judy, did you go through all the decretal paragraphs in the proposed order, particularly paragraph B?
Yes, paragraph B states that Commissioner Fishman shall promptly provide to all parties the notice of persons consulted for advice on relevant matters in this case, and the parties are hereby provided the opportunity to respond under 1.2.3.9 NMAC and this notice shall be filed in the docket and served to all persons listed on this certificate of service.
Thank you, Judy. Mr. Chair, I don't have too much to add to what Judy stated, but I don't think there's a need for us to discuss in detail the nature of the third bench request. I think really the issue at hand is preserving the commission's authority to issue these bench requests. And I think it's clear that this third bench request in question was proper and applicable to that particular rate case. And so I think if we grant this motion for interlocutory appeal, I think it would set a very dangerous precedence and could seriously hamstring our authority going forward. And so that's why I felt compelled to bring this issue before the commission and affirmatively deny the interlocutory appeal. That's all I had, Mr. Chair.
Thank you. Other commissioners, comments?
Mr. Chair, sorry, I was
Go ahead, Commissioner Hall.
slow getting unmuted. No, I just want to say I completely concur in Commissioner Maestas's comments, and I agree with Judy's reasoning. And I think we should stand firm and clarifying for whoever in the public is unsure about what our authority is to seek information from sources that can provide us information here from people at work who are serving us. So I definitely think that is also something that needs to be understood. So I definitely think it would set a bad precedent, and I wholeheartedly support the denial.
And Mr. Chair, if I would, I just wanted to emphasize the single signature order that was issued on June 3rd, which was subsequent to the third bench request, did allow SPS to respond directly to the questions in the third bench request and also respond to the responses of the other parties. So I think that the main concern, at least the initial reaction to the third bench request, was addressed in the subsequent single signature order. But yet I still feel even without the single signature order, that due process was not harmed in any way. So I think that was another effort to address SBS's concerns.
Yep.
Thank you, Mr. Chair.
Thank you. Any other commissioner comments? Yeah, I'm just going to make a couple since my bench request was the subject of this. First of all, there was never any intention to prevent SPS or any other party from responding to any of the questions. So if that appeared to be the intent to anybody, that was just a matter of form. And as Commissioner Maestas said, we quickly sent out a kind of a supplementary order making it clear that that's the case. And so I would apologize to SPS if that was something they were worried about, and if the form that we sent it out in created that concern. But again, I think that's been addressed. I'm very comfortable with everything in the order. Quite honestly, any discussions I've had, I haven't had any discussions regarding SPS and their rate case specifically with anyone. All of my inquiries were just kind of general policy questions, gathering information as to how to address an issue, and basically get the kind of background that I felt I needed to make a good decision. And quite frankly, no different than us going to a class to get educated at NARUC, or one of the NMSU rate making classes, just getting general information to enable us to do a better job. And I have no problem, if I can, I'm going to go find it somewhere in my calendar. Hopefully I have the names of the professors that I consulted with at NMSU. I'm sure I'll be able to track it down, and I'll get that information out to everybody. But I did talk to a couple of professors on general issues in the finance department there. Finally, I just want to point out that you just look at 62-10-10 NMSA, clearly stated in statute that commissioners have the authority to ask questions of any parties in open dockets. And it's as clear as day. And I will say that before putting us through this, I wish that SPS had just quickly checked the statutes, and this would not have arisen. So at any rate, those are my comments. And any other comments from commissioners?
Mr. Chair,
Commissioner Vastus.
if I would, I'd like to make a motion unless there are any potential amendments to the order, but I'd like to move to approve the order denying Southwestern Public Service Company's motion for interlocutory appeal and motion to rescind the third bench request order and granting motion to clarify order for response and request for ruling.
I'll second that.
Any other commissioner comments? Okay, Mike, please take the roll.
Commissioner Hall,
Aye.
Commissioner Maestas,
Aye.
Commissioner Vicente Aguilar,
Aye.
Commissioner Fishman,
Aye.
Commissioner Byrd.
I can safely vote no.
You can.
The order is approved by a vote of 4-1.
Commissioner Byrd, he took himself to the woodshed. Wasn't that enough?
I actually agree with a lot of any commissioner has the right to ask questions about an open docket. I don't have any disagreement with that whatsoever. My no vote has something more to do with, I think there's other underlying issues that aren't being addressed. But as what this order is addressing, I do agree with the order, just so everybody knows. Thank you.
Okay, not sure I understood that, but we'll go forward and have a chance to talk about it sometime. So we're on to discussion items. And this is regarding 20-104 UT in the matter of the application of El Paso Electric Company for revision of its retail electric rates pursuant to Advice Notice 268. And Carolyn and Russell, you have this one.
Good afternoon, Mr. Chairman, Commissioners. Can you hear me?
Yes.
I'll just give a very brief introduction before Carolyn gives a very long presentation. As you know, we have at least 2, and if needed, 3 open meetings in which to consider a final order in this EP rate case. The statutory deadline is June 28th. So today Carolyn will be presenting maybe half of her RD, maybe more. As I said in my memo, I think the way to go in terms of making this move faster is that Carolyn will just be presenting the subject matters within the RD that are the subjects of exceptions to the RD. And I included on my memo a list of the exceptions filed by 3 parties, including EPE. If there are any other areas that the commissioners would like to have Carolyn present, like maybe for next week, if there's any left over, then please let me know. I haven't heard from any commissioners, so Carolyn will just start presenting the subject matter areas that are the subjects of exceptions. And with that, I will turn it over to Carolyn.
Good afternoon, Mr. Chair and Commissioners. First, please let me know if I'm giving you too much or too little information. And second, please feel free to interrupt me during my presentation. I'm going to put my recommended decision up. Can you see it?
Yes.
Okay. So I'm going to start here with a summary of the party staffs and my recommended revenue requirements and base revenue decreases. First, as I state right here, EPE used a calendar year 2019 base period. And I just want to explain a little more about that because this is relevant to some of the issues. The base period is the 12-month period used to measure costs incurred by EPE and to fix rates to produce revenues to match the costs of that period. EPE's test year period is also calendar year 2019. The difference between the numbers in the base period and the numbers in the test year period is that the test year period represents the data from the base period after known and measurable adjustments. This table shows EPE's requested revenue increase, which is about $5.1 million, a 4.3% revenue increase. And this table shows the recommended revenue increase from EPE and then the recommended revenue decreases from staff and all the parties who weighed in on whether EPE should receive a revenue increase. And it's in order with respect to the recommended revenue decreases, the table goes in order starting with the lowest recommended decrease to the highest. So you can see that staff has the lowest recommended decrease at about $391,000. Next is my recommended revenue decrease of about $3.3 million. Next is the Attorney General at about $3.4 million. So I'm fairly close to the Attorney General's recommendation. Next is Philip Simpson's recommendation of a $3.9 million decrease. Next is Doña Ana County's recommendation of the $6.3 million revenue decrease. And finally is the City of Las Cruces recommended revenue decrease of about $7.56 million. Additionally, I am recommending, and this is now uncontested, that EPE refund about $807,000 annually to customers through a 3-year limited term rate rider representing for the years 2018 through 2020, the net of the return to customers of reversed excess protected accumulated deferred income taxes, otherwise known as excess ADIT, and the collection from customers of excess unprotected ADIT, both resulting from enactment of the Tax Cuts and Jobs Act, which reduced tax rates for corporations from 35% to 21% effective January 1, 2018. Next, on this page and the following page are my recommended adjustments to EPE's requested revenue requirement. So this lists each of my recommended revenue decreases. And I have highlighted the ones that are the subject of exceptions and the ones that I will be discussing today. So the first one I'll discuss is my recommendation to reduce EPE's requested 10.3% return on equity to my recommended 9% return on equity. And that results, my recommendation results in about a $4 million decrease in EPE's requested revenue requirement. So return on equity, the commission's awarded or authorized return on equity is the percentage return that the commission authorizes a utility the ability to earn. It's not guaranteed, but the commission is authorizing a utility the opportunity or ability to earn that return. In contested rate cases involving PNM, EPE, and SPS, witnesses consistently estimate cost of equity using multiple methods, including the discounted cash flow method or DCF method, the capital asset pricing method or CAPM method, the risk premium method, and the expected earnings method. This case is no different. Each of these methods was used by at least one ROE, and I'm referring to return on equity as ROE witness.
So Carolyn?
Yes.
This is Commissioner Fishman. To put it in layman's terms as best I can, and tell me if you think this is accurate. I kind of view ROE, us determining the ROE, as us deciding how much ratepayers pay investors for putting up the money to run the utility. Is that an accurate statement?
Commissioner Fishman, I think that's an accurate statement, but I think there's another side to that, which is the return on equity is an amount that is, again, a utility is given the opportunity to earn. So I think it's two-sided, if you understand what I'm saying.
Yeah, so both can be true. Okay, thank you.
And I'm just going through, I highlighted what I'm going to be reading. I'm not, of course, going to be reading the entire recommended decision. The table on this page shows the recommended ROEs among those parties and staff who presented a witness who testified on ROE. Again, EPE's witness is proposing a 10.3% ROE. Staff's witness proposes a 9.3% ROE. The Attorney General's witness recommends a 9% ROE. And the city and the county had a joint witness, and they recommend a 9% ROE. Mr. Simpson did not present testimony on ROE, but also recommends a 9% ROE based on the testimony of the ROE witnesses. And just to give you a heads up, well, you know this already, my recommendation, as I'll be explaining, is 9%. So here I'll give you a brief summary of how each of the ROE witnesses came up with his or her ROE recommendation. First, EPE witness Nelson testified that an ROE in the range of 9.75% to 10.75% is the range of investors' required return to invest in EPE. Given the uncertainty surrounding the scope and duration of the current market dislocation, she believes that an ROE toward the upper end of her recommended range would be reasonable. However, she says that a 10.3% ROE, which is slightly above the midpoint of her identified range, reasonably balances the interests of shareholders and customers. Ms. Nelson relied on 4 approaches to reach her recommended ROE. 1, the DCF method. 2, the CAP-M method. 3, the bond yield plus risk premium method. And 4, the expected earnings method. In addition to these methods, Ms. Nelson considered 1, EPE's planned capital expenditures, 2, EPE's owned nuclear generation, 3, EPE's small size, 4, the regulatory environment in which EPE operates, and 5, the currently unstable capital market. Because the latter 5 factors cannot be directly quantified, Ms. Nelson did not make any numerical adjustments to her ROE results based on those factors, but considered them in determining where EPE's ROE lies within her range of required ROEs. Next, AG witness Kale recommends a 9% ROE. He based his recommendation on 2 DCF analyses, one using Ms. Nelson's 21 company proxy group and one using his slightly different 23 company proxy group. His DCF analysis using his proxy group results in a range of ROEs from 8.2% to 8.7%, with a midpoint of about 8.5%. His DCF analysis using Ms. Nelson's proxy group results in a range of ROEs from 8.2% to 9.2%, with a midpoint of 8.7%. For his 2 studies, the average of the midpoints is 8.6%, and the average of the upper bound results is 8.95%. Mr. Kale's 9% recommendation approximates the upper end of the results of his DCF analyses, averaging those 2 analyses, and is about 0.4% above the midpoint. His 9% ROE recommendation reflects the possibility that EPE might be slightly riskier than the proxy group companies based on its credit ratings. The joint city-county witness, David Garrett, testified that EPE's actual cost of equity is approximately 7%, which is the average of his DCF analysis and his CAP-M analysis. Mr. Garrett explained that this cost of equity appears low because nationwide awarded ROEs are consistently higher than utilities' actual market-based costs of equity. However, he does not recommend a 7% ROE because he believes that gradualism should be applied to moving awarded ROEs closer to market-based ROEs. Applying gradualism, Mr. Garrett recommends a 9% ROE, which he says represents a gradual move toward EPE's market-based cost of equity and would be fair to shareholders because 9% is about 250 basis points above EPE's market-based cost of equity. Mr. Garrett said that the United States Supreme Court cases of Hope and Bluefield do not require that the awarded ROE equals the actual cost of equity, but he said that the actual cost of equity should be the starting point.
Carolyn, this is Commissioner Fishman again. So there's a statement here that it would be fair to shareholders because it's 250 basis points above EPE's cost of equity. So my question is it fair to ratepayers? It's our job to balance. And great, I'm glad the stockholders are happy with this, but boy, 250 basis points is about a 30% premium over his calculated return, what it should be. That seems to me a big premium for ratepayers to pay. Am I missing something there?
Well, as I just said, Mr. Garrett recommends a higher ROE than the actual cost of equity that he calculated. And he says in his testimony that he does that because he's applying gradualism. He says that while generally reducing awarded ROEs for utilities would move awarded returns closer to market-based costs and reduce part of the excess transfer of wealth from ratepayers to shareholders, I believe it is advisable to do so gradually. One of the primary reasons the company's cost of equity is so low is because the company is a very low-risk asset. In general, utility stocks are low-risk investments because movements in their stock prices are relatively involatile. If the commission were to make a significant sudden change in the awarded ROE anticipated by regulatory stakeholders, he says it could have the undesirable effect of notably increasing the company's risk profile and would arguably be at odds with the Supreme Court's end result doctrine. He says that an awarded ROE of 9% represents a good balance.
So I look at that, and the last awarded ROE was, I think, what, 9.48?
I believe that's correct.
And that was 5 years ago. So over 5 years, and they're at a 9% ROE, we're only reducing the ROE by 10 basis points per year, or approximately 1% downwards per year. I mean, how much? That is awfully gradual. If any change we looked at in any of our regulatory activities was at the 1% level, none of our changes would ever have any meaningful impact. I could go and say 8.5%, which is certainly his modeling goes way below that, and say, gee, we're only changing it, your return by only 2% of the total per year, your actual profit that you can theoretically achieve under our awarded revenues. I have a really hard time seeing how gradualism, how gradualism becomes an issue here. And particularly since we're looking at markets, and markets, if I look at the S&P 500, and it's in the record, several places they show the markets volatility. If I look at the S&P 500, it can routinely change 10 to 20% a year. And the whole reason we're giving this big risk premium, 6% say, or 7% over a T-bond, is because investors in equities take risks. And if they're willing to accept 10 to 20% changes in the market routinely, this is a drop in the bucket. So I just want to make the point that Mr. Garrett is recommending a 9% ROE based on gradualism. His real number is 7%, far below that. And I find he's applying, my take is he's applying a gradualism standard here that in this context, at least for me, doesn't make a lot of sense. So just to get that out there.
Mr. Chair.
Carolyn,
Yes.
go ahead, Commissioner Hall.
I just wanted to say I concur with that reasoning. I found it really troublesome to hear that Mr. Garrett's advice is 2 percentage points higher in terms of return on equity, simply based on this principle of gradualism. I appreciate the adverse effects that are described by the utilities, but I think upon closer scrutiny, as I recall, in answers to the bench request, Mr. Garrett seemed to concede that there may not be the adverse effect that we expect in the ability of the utilities to attract capital if their ROE dips, more than what gradualism would dictate. So, well, that's all I want to say for now.
Commissioner Hall, I'd like to say, I hear an echo. Do other people?
Well, just went away.
Okay. I did not address in my recommended decision whether gradualism should apply when the commission determines what the awarded ROE should be. However, I did reject an important part of Mr. Garrett's DCF analysis. And what I rejected, this is on page 67 and 68 of my recommended decision. I recommended his proposed growth rate of 3.9%, which is the gross domestic product. And I did that because this commission has rejected use of the GDP as the growth rate in several cases and has soundly rejected that. I did not accept, I would say indirectly, by rejecting his use of the GDP as the growth rate, I indirectly rejected his DCF results.
Yes, I appreciate that. I noticed somewhere else you mentioned that you're basing the decision in this case on, not on national metrics.
Not on the GDP, correct?
And I appreciate that too. But I don't feel bound by it all the time. As I'm sure you're aware. But I think, well, there's certainly rationality in looking at one's own area of jurisdiction. I don't know that the commission should completely disregard these other economic arguments that that are strong. But I'm just talking generally now, so we can move on from this.
So Carolyn, I'm getting the echo again. The reason I raised the ROE issue here is that in your final decision of 9%, you note that basically Garrett and Cahall had witnesses had recommended 9%. And the reason I bring it up is that quite honestly, I believe it should be lower than 9%. And I think the evidence shows that. And I just want to point out that when Garrett is recommending 9%, what he's really saying is it actually should be much lower, but I'm afraid of other consequences if I go too low, and I actually give ratepayers what I think the right rate of, or excuse me, give shareholders what I think the right rate of return is. So I just wanted to make that clear by raising the issue here. And again, that's simply my reading of the evidence, nothing more than that. My personal reading.
Mr. Chair.
Yes, go ahead, Commissioner.
Ms. Glick, I had a more general observation regarding, AG witness Kale and Mr. Garrett, in that they engage in very precise analyses using the DCF method. They use a variation of proxy groups. They calculate an upper limit and a lower limit and even look at an average, but yet throw in a subjective factor that can't necessarily or is not quantified and bump it up. And so it just kind of, I'm an engineer, and we tend to be analytical. And I think when we talk about ROE, this is, as you know, has significant implications in rate cases and certainly to ratepayers and to investors. And so I just see a tendency to do that, to go through a very precise numerical analysis and proceed to look at different statistics, and then throw in, for example, risk factors because of credit ratings. And if it can't be quantified, it should be subjective and commentary. And I saw the same thing with Mr. Garrett. And so I agree with the same lines of comments from Commissioners Hall and Fishman, that there's kind of like this urge to bump it up. So, anyway, just an observation, and I don't, this is my first rate case, and I truly hope this isn't a kind of tendency on the part of witnesses to want to bump it up, to go through a precise analysis and then throw in a fudge factor and try and bump it up. So that's all I had.
I have a name for what I think happened in this case, and it's basically 9% paranoia. People are just terrified of going below 9%, even when the evidence clearly points that direction. And in asking these questions, I want to be sure that we follow the evidence and treat everyone fairly, as opposed to as Commissioner Maestas pointed out, making these kind of squishy, not quantifiable adjustments. So it really is a concern for me as we go forward. But go ahead, Carolyn.
I just want to respond with two things. One is, as I will discuss, I believe the evidence does support a 9% ROE. And second, I lost it. So if I think if I think of what I forgot, I'll say it later.
Mr. Chair.
You're like Mike Smith that way. You always just dish it out straight. So,
Mr. Chair, I don't disagree with our hearing examiner that you could say the evidence supports a 9%, but you could also say the evidence supports, for example, an 8.6%. I think is what the number was when Mr. Garrett went through an exercise in applying gradualism to get to the hypothetical 8% return in one of his responses. I think it was to a second bench request. Because of the range of reasonableness that exists. And I don't recall right off the bat. I know our hearing examiner mentioned the range of reasonableness, and I forget the bottom and top metrics for it, but but in any case, I'm only referring to the concept in general, that because a range of reasonableness exists, I don't think we have to conclude that the hearing examiner has concluded wrongly in saying that the evidence supports a 9% return on equity when within a range of reasonableness, it could also support a lower return on equity. And I think what we have to do as commissioners, in my view, anyhow, what I feel like I need to do is look at gradualism closely and understand, first of all, how strictly does that apply? And secondly, if we have to really feel bound somehow to apply it strictly, what are the parameters there? And I think the bench request questions delved into that to some extent, and I hope we get to a discussion of those at some point, because I found them very elucidating. And I think that whether or not the return on equity that we choose impairs a company's ability to attract capital has great and direct bearing on our balancing process between the interests of the shareholders and the ratepayers. And I think in the past, we probably haven't looked at that. I know we haven't looked at that closely. And I think it's an important analytical step to take. So.
And Commissioner Hall, I agree with you that there is a range of reasonableness, and I just pulled up some kind of general information on determining the fair ROE from my RD. And what it says is determining the fair ROE for a utility is one of the more subjective tasks of the commission. The key consideration is not whether the data and assumptions underlying the choice of a fair ROE are unassailable, but whether the choice is just and reasonable. And as I will discuss later, I have two ranges of reasonableness for each of the proxy groups that I found were reasonable. And the range does include percentages below 9%. So I think I do agree with you that anything within that range is reasonable. And I'll explain why I came to 9%.
Thank you.
Okay. And then lastly, staff witness Tupler, using the DCF method, recommended initially a 9% ROE in his direct testimony. In his second supplemental testimony, he revised his recommended ROE to 9.3%. He explained that following the filing of his direct testimony, EPE's responses to staff's interrogatories and his further analysis of EPE's debt load, terms, covenants, and conditions caused him to reconsider where EPE's ROE should fall within the range of reasonableness, which he determined was 9% to 9.55%. I found that the constant growth DCF method should be used to determine EPE's authorized ROE. This commission has consistently rejected ROE analyses that combine the results of multiple methods, finding that it should continue its primary reliance on the constant growth DCF method. In the 2015 EPE rate case, the commission, in continuing its primary reliance on the DCF method, rejected EPE's proposal to set the ROE by combining the results of the DCF and CAPM methods. So this and then I'll just say, beyond this commission, the DCF method is widely relied upon by the regulatory community. AG witness Kale said its widespread acceptance among regulators is due to the fact that the method is market-based and is derived from standard economic/financial theory. The method, as typically used, is also transparent and generally understandable. There were some challenges to using the DCF method that I discuss in detail in this section. I'm not going to repeat all that, just going to state my conclusion on that, which is that because no party provided sufficient justification to depart from commission precedent, the results of the constant growth DCF method should be used to determine a reasonable range of ROEs in this case. The next section deals with basically inputs into the DCF formula. There are a lot of different inputs, and often the inputs are the subject of a lot of controversy. However, I understand that none of the inputs are the subject of exceptions. So I'm going to skip this part of my RD. So here I talk about the results of the constant growth DCF analyses using my recommended inputs. I used exhibits prepared by EPE witness Nelson. And for each exhibit, she calculated mean, mean low, and mean high results. For the mean result, she calculated each proxy company's ROE using the average of the growth rate estimates and the proxy company's dividend yield. The mean DCF result is the average of the ROEs calculated for each proxy company. For the mean low result, she calculated each company's ROE using the lowest of the growth rate estimates. The low mean result is the average of the low mean ROEs calculated for the proxy companies. For the mean high result, she followed the same procedure but used the highest of the growth rate estimates for each proxy company. Now, I required her to present these results for both her proxy group and Mr. Kale's proxy group. She did that sort of under objection because she disagrees with Mr. Kale's proxy group. But to her credit, she did produce the results that I ordered her to compare the results for the two proxy groups. And these are the results. Using her proxy group, the low ROE is 8.25%, the mean is 9.05%, and the high is 9.82%. Use the results using Mr. Kale's proxy group, the low ROE is 8.19%, the mean is 8.87%, and the high is 9.6%. Now I'm going to talk about authorized ROEs nationwide, and I'm going to read this entire section because I think it's very important because it is a large basis for EPE's objection to a 9% ROE. Much of EPE's basis for objecting to the intervener's recommended 9% ROE is that a 9% ROE is well below ROEs recently authorized for other vertically integrated electric utilities. Ms. Nelson said that EPE must compete with other companies for capital, and because investors consider authorized ROEs in making their investment decisions, investors will not choose to invest in EPE over a similarly situated utility with a higher authorized ROE. She further said that investors would view an authorized 9% ROE as increasing EPE's regulatory risk, making them reluctant to invest in EPE and decreasing the availability of and the cost of capital for EPE. Staff witness Tupler presented evidence from an August 4th, 2020 bulletin from Regulatory Research Associates, or RRA, that the average ROE authorized for electric utilities was 9.55% in 27 cases decided in the first half of 2020 versus 9.65% for 47 cases decided during 2019. ROEs authorized in the first half of 2020 ranged from 8.25% to 10.42%, with a 9.45% median and a 9.55% average. This quotes from the bulletin presented by Mr. Tupler. It states the 2020 electric average is at the lowest level ever witnessed in the industry, and with the recent rate cuts by the U.S. Federal Reserve and the COVID pandemic-induced recession, even lower authorized returns may be on the horizon. The average allowed ROEs for the electric sector have been trending downward since the 1980s, consistent with the declining interest rate environment. In addition, the proliferation of automatic adjustment and investment recovery mechanisms that reduce the business risk of a utility have often been cited as a contributing factor by commissions in authorizing lower ROEs. In his
Carolyn, if I may, I just had a quick question regarding Mr. Tupler's research and the statistics from that bulletin. Did he differentiate whether those average ROEs in 2020 were stipulated or litigated, or was it a combination of stipulated and litigated ROEs? Because as you know, litigated ROEs are generally higher than stipulated ones.
Commissioner Maestas, he did not provide that information. I ordered AG witness Kale, who also presented information from RRA, and I ordered him in supplemental testimony to provide an updated RRA report that would provide more recent numbers. And he said that I don't think he said it's confidential, but he said he was not authorized to provide it. And he provided general information. I think if I had had the actual report, I could give you that information. But I guess it's proprietary.
Okay, because I've seen some national reports, and definitely the average of litigated ROEs are substantially higher than stipulated ones. So just a quick question on that, just so I can, take this kind of research with kind of a grain of salt.
Commissioner, may I ask this? It's a little bit of a diversion here, but are you saying that backwards? I thought I'd read that litigated was lower than stipulated. It's the other way around?
It's the other way around.
Okay. That's
litigated are higher than stipulated.
I'll take a look. Okay.
And there's no evidence in the record about that.
Yeah. Okay. Thank you.
I think that would have been detailed in the report had I been able to see that.
Mr. Chair, I just had a brief question. Well, maybe just a comment. This quote that the hearing examiner just read, Ms. Glick. One comment I would like to make is it says in the center of that paragraph, the average allowed ROEs for the electric sector have been trending downward since the 1980s, consistent with the declining interest rate environment. While that's true, I don't think that tells the whole story, because there is evidence in the record, a table. I forget who created it, but it was referred to by either witness Cahill or Garrett, that does show over a 25-year period, the decline in numerous metrics, about 5 columns in this table. One on the left, the one leftmost one being the decline in ROEs, and then another column farther to the right shows the declining interest rate, cost of debt for utilities, and that has decreased quite a bit more rapidly. So there's not a full correspondence between the rates of decline in those two metrics. And I think that's an important consideration for us commissioners to bear in mind in analyzing the extent of any adverse effect on the companies if we reduce the ROE or not award an ROE at the level the company is asking for.
Commissioner Hall, I agree with you. And I think in just a minute, I'll read that one of the witnesses said what you just did say.
Oh, okay.
So in the AG witness, Cahill's presented evidence from RRA's July 2020 quarterly survey, which reports authorized ROEs for electric utilities averaging 9.64% in 2019 and 9.47% in 2020 through the date of the July 2020 quarterly survey. The reason for the difference in the 2020 averages cited by Mr. Tupler and Mr. Cahill in their direct testimonies is that the 9.55% cited by Mr. Tupler includes ROEs authorized in limited issue rider proceedings, while the 9.47% cited by Mr. Cahill excludes such ROEs. Mr. Cahill, in his second supplemental testimony, and this is where I asked for that report that he said was proprietary, so he did not produce. He did say, he summarized from it, saying that it reported for the period January through September 2020, authorized ROEs, one for electric utilities averaging 9.5%, 2 for vertically integrated utilities averaging 9.54%, and 3 for distribution utilities, averaging 9.22%. For just the third quarter of 2020, the average authorized ROE was 9.3% based on 10 decisions during that quarter. Mr. Garrett said that public utility regulatory commissions have consistently authorized ROEs that are higher than actual utility costs of equity. He said that over the past 30 years, interest rates and cost of capital have declined at a faster rate than regulators' willingness to decrease awarded ROEs. And that goes to what you were just saying, Commissioner Hall.
Yeah.
While awarded ROEs have decreased in accordance with declining capital costs, he said they have not decreased quickly enough to keep pace. He said that to the extent that regulators have conformed to a national average of awarded ROEs when making decisions in particular cases, it has contributed to a lag in awarded returns, which have failed to track with declining interest rates over the same period. He said he would disagree with anyone who suggests that the current cost of equity for a regulatory utility is above 8%. Mr. Kale similarly said that state utility regulatory commissions generally do not like to make drastic changes in authorized ROEs from year to year. He described this phenomenon as regulatory inertia. He concluded that state utility regulatory commissions, quote, are trying to be a bit conservative, and there's room for bringing that down without violating the capital attraction standard, end quote. He referred to this inflation by state utility regulatory commissions as a cushion. Mr. Kale cited evidence other than his DCF analyses to support his conclusion. First, an exhibit sponsored by Ms. Nelson shows that the average market to book ratio for her proxy group companies is 1.93. This indicates that companies are earning substantially above their market determined cost of equity, or investors expect that the companies will achieve earnings above their costs of equity. These market
Well, finish. I'm sorry. Go further.
These market to book ratios indicate that under state utility regulatory commission authorized ROEs, electric utilities are financially thriving, he said. Second, another exhibit sponsored by Ms. Nelson shows that the 30-year Treasury yield has fallen from 13.94% in 1982 to 2.02% in April 2020. However, Mr. Kale said, again, as you said, Commissioner Hall, authorized ROEs have not fallen commensurately with falling long-term interest rates. Mr. Kale said that authorized ROEs have been drifting down, but not as quickly as interest rates have fallen.
Yeah.
So Carolyn, my question on this, and this wording's a little bit confusing to me. This indicates the last line of page 75. Companies are earning substantially above their market determined cost of equity, or that investors expect they will achieve earnings above their market determined cost of equity. And I guess I have another way of looking at it. And that is that that these stock prices are reflecting a market determined cost of equity, and that if regulators are awarding, say, 10% as an ROE, and the stock is then being valued, and I'm going to just round these numbers for simplicity, and the market is valuing the company at twice its book value, other factors being equal, and there are lots of adjustments and other factors to consider. But that would be saying that investors, the actual stock buyer, is only expecting a 5% return because they're paying, they're paying $200 for a book value of $100, and they're happy with that because there's an awarded return of 10%, but they'll bump up the price, and they're competing with other investors, and they're willing to accept 5%. So, when I look at that number, and I realize there's a million adjustments you need to make, and does book value, how does it tie to regulatory assets, and blah, blah, blah. But when I look at this, it seems to me a powerful indicator that the actual market is requires a much smaller return than any of these analyses. And in fact, I did a little calculation using actual numbers that EPE presented in their exhibits. And I think it was like a 10.2%, I got it right here, 10.18% awarded returns to these proxy utilities, and a 1.93% market to book value. And if I look at that, it would say investors are only requiring a 5.3% return. Now, that's a very, there's not a lot of detail behind that number, and it could be very different than that, I acknowledge. But that's a very powerful number saying, wow, we've done all these models, but the market price of the stocks seems to indicate, and this is the actual market, that investors are actually asking for much less than all of these calculations. So, and any thoughts on that? And I remember, by the way, I was at the hearing and asked Mr. Kale about this. And, I probably didn't follow up with the right questions to get stuff on the record, but basically his response was very much, gee, that just shows you these utilities are doing terrifically well. And in fact, though they're much less risky, they're earning recently higher returns for investors than the S&P 500.
So your question, could you repeat your question?
Well, it's not really a question because I really can't. All I'm saying is that if I look at the stock prices as identified here, and I look at the awarded returns from regulators, and then I look at how stock investors have bid the prices of these stocks up way above book value, that shows me that those investors don't require a 9% return. And in fact, if I do a back of the napkin calculation based on EPE's own numbers and its testimony, it would show that they only require 5.3% return. And I would, and by the way, when markets, and this is common, and I'm sure it's in testimony in the theory, is investors, they pay a price they think is based on what's going to happen in the future. They're not looking back. So these are investors that are looking at all the future stuff they think is going to happen, and they're willing to take 5.3%. Now, again, that number may turn out to be 7 or 7.5%, but boy, it'd take a lot of adjustments to get that number up to 9%. So I just want to point out that based on the evidence here, the market's actual pricing of these securities seems to indicate a much lower cost of equity than what our modeling is showing. And I say that not to throw out the modeling, but to point out that if we should be doing any adjustments to the modeling, it shouldn't be bumping the number up. It probably should be bumping the number down.
I was just looking for something that I think is, that I said in here that is consistent with what you just said, Chairman Fishman. If you'll just give me a second. The page numbering on this PDF doesn't match the page numbering on my paper RD, so I can't quickly find it. Here we go. Here we
Go
go.
ahead.
What page is that? What's that page?
This is page 50 on my paper RD.
Right.
So I quote here from FERC about the expected earnings approach. And let me tell you what the expected earnings approach is real quickly. This, I won't go to this page, but page 41 of my RD says the expected earnings method estimates the earnings that an investor expects to receive on the book value of a particular stock. This method uses investment analyst estimates of return on book value. So I'm quoting here from a FERC opinion where FERC rejected using the expected earnings approach. And what FERC found was, quote, moreover, because the current market values of utility stocks substantially exceed utilities' book value, a utility's expected earnings on its book value will inevitably exceed the return that investors require in order to purchase the utility's higher value stock, which means that the expected earnings method does not accurately measure the returns that investors require to invest in utilities. I think that's consistent with what you were just saying.
Well, yeah, in a way it is. But I think what's interesting is the first sentence, because the current market values of utility stocks substantially exceed book value, expected earnings on book value will inevitably exceed the return. Well, there's only one reason that those market values are substantially above book value. That's because of the return that the commissions have awarded them. And so it becomes very circular.
Mhm.
And, that's what part of what makes this so challenging as we wrestle with this. And it's a constantly moving equation. Every time you move something, 4 or 5 things change in the financial equation, and it gets confusing. But I do want to point out that, the only reason that those values are way above book value is that commissions have awarded returns that are far higher than what investors require in order to own a share of that utility. And if we did if we awarded 6 or 7% those market to book values would be much closer together. So it gets very circular, and I'm sorry if I just confused everybody there. I'll shut up.
Mr. Chair,
Yes, go ahead, Commissioner Hall.
I don't think that was confusing at all. It's not confusing. As long as commissions continue to award returns on equity higher than what relates to what is being earned by what higher than they should be. Investors will enjoy a windfall, and fairness to ratepayers will be compromised.
So just to then conclude my discussion of nationwide ROEs, my conclusion, as shown on this page, is based on Mr. Garrett's and Mr. Kale's testimonies. This commission should follow its practice of authorizing an ROE for EPE based on the evidence in this case, not authorized returns nationwide. Okay. So now I'm going to conclude my discussion of ROE with my analysis and how I came up with a recommended 9% ROE. I'm not going to read the entire analysis, just selected parts. As I said before, I relied on the results of Ms. Nelson's constant growth DCF analyses without using sustainable growth rate as an input, in which she derives low mean, mean, and high mean DCF results for her proxy group and Mr. Kale's proxy group. And I found that those results produce a reasonable range of ROEs from which to select EPE's ROE. This range is 8.25% to 9.82% for Ms. Nelson's proxy group and 8.19% to 9.6% for Mr. Kale's proxy group. Where the awarded ROE lies within a reasonable range is subjective and within the commission's broad discretion. I found several considerations should factor into the decision in this case. The first is EPE's slightly riskier investment risk compared to the proxy group average, because its corporate credit ratings are slightly below the average corporate credit rating for the proxy group. A corporate credit rating generally rates a company's overall creditworthiness or capacity to pay its financial obligations. EPE's issuer ratings from S&P, Moody's, and Fitch are BBB. The average S&P long-term issuer rating for the proxy group is A-/BBB+, which is 1 or 2 notches above EPE's current ratings. Mr. Kale described EPE's credit ratings as investment grade, but probably slightly below average for the electric utility industry. Mr. Kale took this into account. In the 2015 P&M rate case, the commission authorized an ROE for P&M on the higher end of the reasonable range of ROEs because of P&M's slightly riskier investment risk compared to the proxy group. P&M's slightly riskier investment risk was evidenced by P&M's Moody's rating, which was below the average of the proxy group. A second consideration in selecting EPE's awarded ROE are the current extraordinarily low capital costs. In mid-September 2020, 30-year Treasury yields were at about 1.4%, and single A utility long-term bond yields were below 3%. These rates are well below levels prevailing in 2015 during EPE's last base rate case. The Federal Open Market Committee indicated in September 2020 that it anticipates the need for a high degree of monetary accommodation, including extremely low interest rates and aggressive quantitative easing for an extended period. The third consideration in selecting EPE's awarded ROE is that I am recommending adoption for rate-making purposes of EPE's requested 51% equity ratio. EPE's capital structure, which I'll discuss later, is relevant to determining its authorized ROE. The commission made this clear in case number 1916, in which it stated, and I'm not going to read that entire quote, just the part that I've highlighted, where the commission said, P&M has proposed the commission increase the amount of equity in the capital structure, but has not included in its proposal the resulting lower cost of equity. It is inappropriate to adjust the capital structure without making a corresponding adjustment in the cost of capital. A fourth consideration in selecting EPE's awarded ROE is that in the 2019 EPE merger case, IIF and EPE represented that IIF's acquisition of EPE was a benefit because EPE would have easier access to capital. EPE witness Nelson did not consider this alleged benefit in her cost of equity analyses. A fifth but not insignificant consideration that should factor into the decision of the awarded ROE is the COVID-19 pandemic's impact on the well-being of customers. So this next paragraph is my conclusion, essentially. EPE's slightly riskier investment risk compared to the proxy group average weighs in favor of awarding EPE a slightly higher ROE within the range of reasonable ROEs. However, the remaining four factors weigh in favor of awarding EPE a lower ROE within the range of reasonable ROEs. And this next sentence is incorrect. It says, it is significant that 3 out of the 4 ROE witnesses recommend a 9% ROE. What I should have said and what I meant to say is 3 out of the 5 parties with ROE witnesses recommend a 9% ROE. A 9% ROE falls within the reasonable range of ROEs produced by Ms. Nelson's constant growth DCF analyses and appropriately balances the 5 factors that should be considered in selecting an ROE within that reasonable range. A 9% ROE is reasonable in light of current extraordinarily low capital costs and the severe economic downturn, which impact the well-being of customers. Therefore, EPE should be authorized a 9% ROE. Conversely, and this, I say 10.4, that should be 10.3% ROE proposed by EPE focuses solely on investor interests at the expense of ratepayer interests and therefore is not a reasonable ROE.
Wait a second. Did you jump ahead or something? You said 10.5 and I don't see that in the text right here. Where?
No, I said in that last sentence where it says conversely, the 10.4% ROE proposed by EPE, that's incorrect. It should say the 10.3% ROE proposed by EPE.
I'm having trouble finding that sentence. It's on page 81, right?
So go up to the second to the last paragraph.
Yeah.
And go to the second, go to the last sentence of that paragraph. It starts with
conversely, there it is. Sorry, I just didn't see it. I thought I was lost. Okay, the 10.4 ROE. Okay, good. Thank you.
EPE argues that authorizing it a 9% ROE would adversely affect its credit metrics and possibly lead to a downgrade of its rating below investment grade. The credit metrics used by the rating agencies focus on cash flow, that is the ratio of cash flow to debt and cash flow to interest expense. EPE relies on a Moody's credit opinion of EPE, which identifies one of 3 credit challenges to EPE as a, quote, less supportive regulatory environment in New Mexico relative to other jurisdictions. EPE also relies on a Fitch report regarding EPE that identifies 2 of 3 ratings drivers for EPE as, quote, relatively challenging regulatory environment, end quote, and quote, rate case filings, end quote. Under rate case filings, the report says, Fitch assumes reasonable outcomes in the upcoming Texas and New Mexico rate cases in line with recent decisions in both states. In New Mexico, SPS, a subsidiary of Excel Energy, recently settled rate cases at a 9.45 ROE and an equity ratio around 54.5 in both jurisdictions.
Mr. Chairman, I want to ask a question here if I could.
Sure, go ahead.
This reminds me of something that I wanted to ask about, well, when I was reading it some days ago, I guess. But I noticed in this case, there was a discussion at the beginning, maybe in the RD, I'm not sure where else I saw it, that Sun Jupiter had, okay, it was a known and measurable change. That Sun Jupiter had infused $125 million, I think was the number of capital into the company following the case being filed, but before it went to hearing. And that had the result of bumping up the equity to debt ratio. The equity went from 51% to 52%. I just assumed, but I wanted to ask, was that a type of move that would have been intentional in order to provide a more attractive equity ratio on Wall Street? Is that why that is done?
Commissioner Hall, there's no evidence there's no evidence at all about that. So I can't answer your question.
Okay, thank you.
Carolyn, but I'll do a follow-up question. What is it? What's the word they used about the regulatory environment? Less favorable?
Challenging.
Challenging. So does anybody define what a challenging regulatory environment is?
Yes, and if you give me a minute to go into the other room, I think I can find that if you want me to.
Yes, I'd like you to, because absent a definition, all that means to me is challenging regulatory environment is they don't give us the return we want. So I need something more than that.
Okay, let me go get that. I'll be right back.
Mr. Chairman, Commissioners, I would just note, it sounds like that description of the challenging regulatory environment in New Mexico compared to other jurisdictions. I guess they're comparing it to Texas, which is where EP has 80% of their customers, and possibly they're referring to the more advanced and forward-looking renewables requirements that we have in New Mexico. I don't know, but that's my guess, but I'll let Carolyn speak about it.
Yeah, it could be a lot of things. So
this comes from that Fitch report, okay. And I'm reading right now from that Fitch report where I'll just read what it says about relatively challenging regulatory environment. Fitch considers Texas and New Mexico to be challenging regulatory environments, in particular New Mexico, which is approximately 20% of revenues. Both states typically used historical test year filings with partial true-ups. Utilities in Texas and New Mexico historically received authorized ROEs slightly lower than the nationwide average. Regulatory lag from the use of a historical test year in Texas and other factors in the rate setting process in New Mexico have made it difficult for EPE to earn authorized ROEs. Offsetting some of the challenges are supportive rate mechanisms, such as fuel and purchase power recovery mechanisms and riders for energy efficiency program costs. In Texas, as of 2019, EPE was able to recover its investment, but I'm not going to read the rest of that. That just refers to Texas. So that is their discussion in that report.
Okay, thank you. That helps. Appreciate it.
I have a question. Do we know, Ms. Glick, what time period was that analysis covering? And I'm asking that with respect to other factors, which may not obtain now because we have a very clear statute in place that is directing essentially, the procurement path for utilities going forward. I mean, to the extent we may have been perceived as of creating regulatory uncertainty, I think we have a much more certain environment given the Energy Transition Act and actions that have to fall out from that application.
Commissioner Hall, this report does not have a date on it, but it does give a new rating as of May 26, 2020. So I'm assuming that's the approximate date of the report.
Okay. How often are those reports generated?
I don't know the answer to that.
Okay. Thank you.
When asked whether a reduced ROE would adversely affect EPE's credit metrics, AG witness Kale responded, "It depends on how much. All else equal, strictly speaking, it would, in that, as we discussed earlier, the return on equity is one component of the company's cash flow, and credit metrics are based upon cash flow metrics. All else equal, if you take away some ROE dollars, cash flow will be less, and all else equal, that will result in a reduced cash flow to debt ratio or cash flow to interest ratio." Then, when asked whether he performed an analysis of whether his recommended 9% ROE would adversely affect EPE's credit metrics, Mr. Kale responded, "Well, I didn't perform a formal analysis. What I did was I inspected the company's credit rating reports, and those credit rating reports have the data on the credit metrics, particularly Moody's. They seem to be more exclusive than Standard & Poor's. Just my recollection is that the company has cash flow of a couple $100 million a year, and a reduction in the amount of relief from the current ROE from 9.48% to 9% might result in a reduction of cash flow of something on the order of maybe $1 million, or maybe a little bit more than that. That kind of change in the company's cash flow is almost a rounding error on its credit metrics. It's a pretty small change. I can't imagine that kind of change by itself triggering any change in credit metrics." And then I said, significantly, while EPE attempted to discount Mr. Kale's testimony because Mr. Kale did not perform an analysis of whether his recommended ROE would adversely affect EPE's credit metrics, EPE also presented no such evidence, just speculation. And I found this on this page here. I found this quote from FERC to be exactly on point. FERC said, "Although any rate reduction by reducing earnings will necessarily adversely affect certain financial metrics, that does not preclude the Commission from reducing rates. It is not incumbent on the Commission to demonstrate that any rate reduction, if supported by evidence demonstrating reduced cost of capital, would not adversely affect utilities' financial metrics. By the logic of certain parties, virtually any rate reduction would be unjust and unreasonable simply because it reduces the ROA and thus harms financial metrics for the affected utilities.
So Carolyn, Mr. Cahill had, in bumping his up to 9%, had cited potential credit risks.
Where are you referring to, Mr. Chairman?
That's not exactly correct. He said that EPE has a slightly, its rating, its issuer rating is slightly lower than the proxy group average.
Right, which might indicate a higher level of risk. And therefore, he felt comfortable bumping the number up to 9%?
Yes.
Okay. And I'm looking at, if his own analysis was 8.5% or averaged the proxy groups, it was 8.6%, using the DCF as a midpoint, okay, knowing it's all within a range. Would, let's say their credit rating dropped down, how much would that actually cost in terms of their cost of debt? Because we're automatically adding half of, if we go from 8.5, I'll use that, we're automatically adding half a point to the cost of equity, which is half their capital structure, a little bit more. Let's say the credit rating would go down. Would that add a full 0.5% to interest rates? I don't know if there's any evidence on the record about that. So
There's not, and that's part of why I said here, EPE just, they presented no evidence either, just speculation.
yeah, it's winging it. Although I have to say that sounds like an awfully high number to me, given the current cost of debt, that could possibly happen. And then second of all, most of their debt's already locked in, so it's not going to change anyway. This credit thing feels a little bit like a red herring in terms of its actual impact on rate payers. And there's since there's no data to back it, I tend to not give it a lot of weight. So just a comment.
And Commissioner Fishman, that's obviously my conclusion from what I just read.
Oh, okay. I see that. Yeah, from FERC.
Right, Mr. Chair. FERC is just saying it's not, the burden is not on the commission to show that there would be no adverse credit effect in setting rates.
And I would also point out, and I know this is going to sound like blasphemy, but I'll say it anyway, is that as Mr. Cahill had testified, and my background in finance, is that credit rating is very much dependent on the cash flow, interest rate coverage, and debt coverage. And if there was some terrible consequence of a potential lowering of credit rating, that would easily be solved by making a minor reduction to the dividend rate. And understanding that the dividend is simply how much money ratepayers are paying to investors for putting up the money. And that's not a tragedy. That's just part of the whole balancing act of what's an equal or a equitable is the word I'm looking for, an equitable cost of equity or ROE for the ratepayers. And, you know, ratepayers just went through or just going through a big bump in their costs due to the February event. And they're taking that big bump, they're taking that risk, not the utility. And it feels like, you know, if I look at that, we're very comfortable with saying, okay, ratepayers pick up these costs and these risks, but it's feeling under these arguments that I'm hearing from, or that I'm seeing from the companies, is that, boy, it's just like the earth fell in if the dividend happened to, if we had to drop the dividend by some minor amount at some point in order to get the right debt coverage. It just feels to me like we're looking at something where volatility is absolutely fine for the ratepayer, but not for the utility, even in the way we award our ROEs. And I'm not articulating it very well, but I have to say I'm feeling uncomfortable with it.
Mr. Chair, I think that last point you made is really crucial. Volatility may be okay for the ratepayer, but not for the company. That's one of the interests that we have to balance. And I think you put it into good relief there in your discussion. So I appreciate it myself.
So I'll just conclude my discussion of ROE with my my conclusion, in which I said a 9% authorized ROE combined with an authorized capital structure of 51% equity is sufficient for EPE to maintain its credit rating and financial integrity under efficient management. Additionally, a 9% ROE is reasonable in light of current extraordinarily low capital costs and the severe economic downturn, which impacts the well-being of customers. So are there any more questions on ROE? Do you all want to discuss that anymore before I go on?
I'm going to raise a couple of other quick things because I've obviously been digging deeply into this one. And Carol, and everything else in your decision, I happen to feel really comfortable with. It was just this one area. In the court decisions, it says you can compare multiple models, and what's not discussed. I'm sorry, what, Commissioner?
I didn't quite catch everything you said there. In a court decision, or what?
So in the Supreme Court decision, you know, it says you can. You're not tied to one model. You can look at multiple models. Ours happens to be the DCF, which is fine. You know, I think that's good to use that model. It's just so much depends on the assumptions you put into them. But some jurisdictions also use the CAPM model, and certainly the courts have, if I remember what I read correctly, have encouraged using multiple models and just to kind of test your results and be sure you're comfortable with them. We've got CAPM analysis here as well, both from the Attorney General and from Las Cruces, so their witnesses. And that actually come out very close to each other. I think they come out to like 7 and 7.1% on the CAPM models. And I don't see that considered anywhere in your decision. It's something that might modify the way you think about the discounted cash flow model. Can you speak to that?
Yes, Commissioner Fishman. It's on page 49 of the paper copy of my RD. Okay. Let me see if I can find it on here.
It's so long, your RD, I didn't take good enough notes on it. but I read it all.
That's not a
So-
criticism of it.
Here we go.
right?
No, that's thoroughness.
Really valuable.
I rejected using the CAPM method, directly relying on it. I said, Mr. Kale persuasively showed that contrary to Mr. Garrett's testimony, the CAPM method should not be directly relied on, but at most should be used as a check on the DCF method for 3 reasons. First, Mr. Kale said that the CAPM method uses 30-year treasury yields as an input, and we're in an unusual time with regard to yields on treasury securities. Second, he said that it is very, very difficult to reliably estimate the market risk premium. Third, he said that betas have been jumping around. In her direct testimony, Ms. Nelson reported a proxy group beta of 0.987 using Bloomberg data and a proxy group beta of 0.53 using value line data, a difference of about 86%. The value line betas used by Mr. Kale averaged 0.87, while Ms. Nelson's betas, also from value line, but at an earlier publication date, averaged 0.53. This is more than a 60% increase and profoundly affects the CAPM results. Mr. Kale said, for all those reasons, since we have a perfectly good method, the DCF, why do we need to go to the CAPM when it's got all these problems? He concluded that the CAPM is not very useful or reliable at this time.
Okay. And actually, I recall from Mr. Garrett's testimony that he preferred CAPM to DCF. Do you recall what his arguments were?
Yeah.
You are correct that he did say that he prefers it. And, here it is.
Page 49? It's right above
Yes,
Kale?
yes, yeah. Mr. Garrett said he does not recommend that the commission, not rely on the DCF method, but he believes that the CAPM method is superior to the DCF method. He said that the DCF method presents circularity issues because the stock prices of utilities are included in the things we're trying to measure for the ultimate thing we're trying to get to, which is the award of ROE. However, Mr. Garrett acknowledged that stock prices are used to calculate the beta coefficient in the CAPM method.
Okay. Then one other question here. When we're talking about interest rates, and this obviously to some degree relates back to the CAPM model, which starts as with an interest rate as the risk-free number. But looking back at an exhibit, I can't recall where I saw it anyway, it was showing interest rates at around Treasury interest rates at around 3%, 2.93% for 2015 during the last rate case. And I know in your decision, it shows a 1.4% interest rate, which is a little dangerous for the reasons that Mr. Kale pointed out. And certainly before COVID, the interest rate numbers in the exhibit that we saw were around 2%. And I don't know if I can say anything about current Treasury interest rates if that's going off the record, so I'll avoid doing that. But other than to say that, well, I won't even go there. But my point is that even taking account of the COVID unreliable dip, even if we correct back to the just before COVID interest rate, there was a significant drop in the Treasury rate, almost almost 1%, maybe 0.7 to 1.0%. And we've talked about this idea that ROEs declines have not kept up with interest rate declines. And I can't help but point out that in this case, our recommended decision of 9%, we're reducing the ROE by 0.48%. Yet over that same time period, the actual Treasury interest rates dropped somewhere in the range of 0.7 or 0.8%. And that if we're comparing ROEs to interest rates in terms of lagging, even if we correct for COVID, we're still falling behind. It's getting worse with this 9% recommendation, not getting better. And to me, again, that doesn't cause me to throw out DCF models, but it really pushes me towards looking at the lower range. Is that we're not keeping up with interest rates. Market prices seem to indicate investors have a lower demand. I tend not to want to throw out CAPM altogether, as Mr. Kale suggests. But all those things point to, gee, if we're considering other factors, we should be looking at a downward adjustment to the DCF or going low in the range of DCF. And to me, those are three pretty compelling reasons to take another look and see if maybe we should adjust down. And one question, what did EPE ask in its exception? Was there anything specific?
You'd have to ask Russell that.
Oh, Russell?
Yes, I'm sorry. Could you repeat that question?
What did EPE ask for in its exceptions in terms of ROE?
At a minimum, they said 9.345, which comes from, let me see, their exceptions. They said at a minimum. And they emphasized that 0.37, even though it hadn't been identified as the risk premium throughout by Ms. Nelson throughout the hearing, they also think that's a reasonable risk premium over and above 9%, so 9.37, but they said at a minimum 9.345.
Okay.
I'm confused. Just a minute. Why are we talking about a risk premium? We're talking about the DCF model, right?
Yeah, Commissioner Hall, yes. The EPE, one of their major arguments in the exceptions is that the proxy group that they chose did not share exactly the risk profile that EPE has. That EPE has a higher risk profile due to the fact that it's a smaller company. I think the regulatory environment was part of it, and also that they're making I think substantial capital investments in the near future. Although, as Carolyn pointed out, one of those is for a large part of this for the Newman Unit 6.
What's that you say again? Although what?
I'm sorry. So they had, I think, three reasons that they gave why they felt that that they had a higher risk profile than the proxy group that they had chosen, and that they really couldn't find a proxy group that was absolutely on point for their own risk profile. So they came up with 0.37% as their risk premium and added that to the 9 as an alternative, 9.37%. They thought would be a more reasonable ROE. And the three factors that they considered made them riskier than their proxy group were: 1, a smaller size; 2, I believe that it was the issue with that we already discussed with the regulatory environment. And the third, what was the third? I was just talking about the third. The third was, that they're going to be making substantial capital investments. And that they said that made them riskier at this time. And I think it was Dr. Kale said that, you know, a smaller size company doesn't result in any higher risk premium. Neither does the fact that you're making capital investments. And something that Carolyn pointed out in her RD was that a big part of the capital investments that they're making now, part of that's for the Newman Unit 6 gas plant, which was disallowed by the commission for CCN because it's not in accordance with the ETA. So that really, even if you were to consider that, which generally Dr. Kahan said you wouldn't be considering capital infusions as part of our risk profile, or capital expenditures, the part of that part's going to Texas. So there may be some other things that there are some other things going to New Mexico, but those were the reasons why they came up with a risk premium over and above the proxy group.
Russell, I have a question. Was this risk premium argument in their exceptions based on some testimony of their witness, or was it argument just created by the attorney?
It was based on some testimony by Ms. Nelson, their witness. Although, like I said, I think what had been pointed out in the by Dr. Kahan was that, or Kale, I'm
Kale.
was that that 0.37 hadn't been identified as a risk premium when it was in the testimony in which it was identified. So I'd have to, I can look at that more closely for next week when we talk about the exceptions, but
yeah, I'd be interested to understand how that.
Yeah. I think it's a combination of what was in the testimony, that number was there, and I think I think possibly later argued this is what a proper risk premium, where it hadn't been labeled that before.
Okay, and Miss Hearing Examiner, if I can just seek your clarification. Risk premium is an element of a different type of methodology, not discounted cash flow analysis, correct? I forget the name of the methodology. It's a different one. It's
risk premium method.
Risk premium methodology, that's right. Yeah, okay. So the company is arguing in their exceptions that they should have an additional risk premium added on to the return on equity that they seek under the discounted cash flow methodology. Is that's what it sounds like to me. So it sounds like, I guess at the point of filing exceptions, the company is trying to use two methodologies or a combination of methodologies to bump up their request further.
Yes, the company argues that first they argue that the commission shouldn't use just discounted, just the constant growth DCF model, that it should use a blend of models. But they say even if you do apply just this test, you should take into account that risk premium because this test is based on a proxy group that is less risky than EPE's business.
Is that your advice? Is that what you're saying?
That's EPE's argument.
Oh, I see. Okay.
So they're making arguments in the alternative. One is that you shouldn't just rely on this DCF method alone, but if you do, then you should take into account the risk premium.
Oh, I see. Okay, thanks a lot, Russell. I appreciate it. Mr. Chair, I do have a question for Ms. Glick.
Yeah, keep going.
Now, wait, I have to go to the page and you'll have to help me, Ms. Carolyn, where you reached your conclusion. You read it to us and now I'm not finding it, about why it's reasonable to pick 9%. That you read that to us recently.
Let me see if I can find that.
In the software, it's too far.
Oh, and just a little correction of what I said, Commissioner Hall.
Here it is, 81. It's on page 81. I'm sorry, Russell. What was that?
But in their exceptions, I thought at one point they say at a minimum it should be 9.345, which is what EPA thinks would be the correct application of the constant growth DCF model. But they said, then they, on another place, say at a minimum, it should be, the ROE should be no lower than staff's recommendation of 9.3%. So that's about the range that they're in for their minimum.
Oh, thank you. Thank you very much. That's clarifying. I think it's on, wait,
You said page 81 a minute ago, Commissioner Hall?
sorry?
You said page 81 a minute ago? You were looking for,
Yes, and I thought it was on page 81, but I didn't see that right. Do you know where we're looking, Carolyn, now? Did you find the page?
Of my, why I said 9% is reasonable,
Yes.
page 83.
Oh, okay. Oh, yeah, okay. So you say a 9% authorized ROE combined with the capital structure of 51 equity is sufficient for EPE to maintain its credit rating and financial integrity under efficient management. And it's reasonable in light of current extraordinarily low capital costs and severe economic downturn as well. So my question is, what if we chose, for example, an 8.9% rather percent ROE instead of a 9? Would you still say it's reasonable?
Yes, because I said that a reasonable range, let me tell you what I said the reasonable ranges are that I found.
Oh, good.
Okay, here.
What page is that?
This is page 77. I found two reasonable ranges based on the two proxy groups. So for Ms. Nelson's proxy group, I found a reasonable range is 8.25% to 9.82%. And for Mr. Kale's, from 8.19% to 9.6.
Okay, yeah, and that's put together in that table. Isn't it?
Yeah.
Yes,
Yeah.
on page 73. And so, I mean,
Yes.
Okay, I appreciate that. So that shows a low of 8.19 as the lowest ROE from Mr. Kale, and the highest ROE on this table is 9.82. Are you saying that's the range that you think is reasonable?
Yeah, I found that each proxy group was reasonable, and that so using the results, using my recommended inputs to the DCF method, I found that that those ranges of ROEs would be reasonable ranges to choose from, and that anything within that range is within those ranges is reasonable. And it's really a judgment call as to where to go within those ranges.
Great, thank you very much.
Commissioner Hall, thank you for that. There's that other table that's below that's got slightly lower or slightly different numbers in it.
Yeah.
Proxy groups, what's that about?
This is this would be including the sustainable growth rate instead of analyst growth rates as one of the growth rates in the equation. And I found that based on evidence from both Ms. Nelson and Mr. Kale, that the sustainable growth rate should not be used as a direct input.
Okay.
Why is that? Why was that now? I'm looking at it, I think, but could you explain that?
Sure, I have to find it real quick.
That's all these tables are on page 73, but if there was some
My explanation of that is somewhere else. Just a minute.
Yeah, okay.
Okay.
Oh, on page 69, there's a discussion about sustainable.
Yeah, I think it's 69 to 70. And that's quite a long discussion. I don't know if you want me to go through that or not.
Yeah, I do.
Okay.
Good. Should we be taking a break, or are people getting tired, or do you want to finish this up before we take a break?
I'd like to finish it up.
Okay, so we'll finish this up and then take a break after that.
Okay. So I, in a bench request, asked Ms. Nelson and Mr. Kale to respond to a statement made, well, a discussion by Dr. Morin, who authored a book called Utilities Cost of Capital, in which he discussed the sustainable growth rate. And I asked Ms. Nelson and Mr. Kale, whether they agreed with Dr. Morin's identification of two problems with the practical application of the sustainable growth method. And I further asked them whether the commission should use the sustainable growth rate along with analyst growth rates as an input into the DCF method or only as a check on it. Ms. Nelson responded that she generally agreed in principle with the two problems identified by Dr. Morin, but she noted that Dr. Morin acknowledged that neither problem is prohibitively serious. She did not state an opinion on whether the commission should use the sustainable growth rate as a direct input into the DCF formula. Mr. Kale gave, I thought, a better response. He said that the potential circularity identified by Dr. Morin appears to assume that the constant growth DCF method is being applied to a single company. He said that this criticism is not relevant when a large proxy group is used, as in this case. He said, however, that the first problem identified by Dr. Morin, estimating what B and R investors have in mind, is valid, and B and R are inputs into the sustainable growth method. Mr. Kale said that most rate of return analysts rely on value line projections to determine sustainable growth rates, because value line projections tend to be viewed as authoritative and available to investors. And most importantly, Value Line is one of the few publications that consistently provides long-term projections of B and R. However, he concluded, but whether investors would actually utilize the Value Line data to obtain their projections for long-term growth is difficult to determine. Hence, the necessity of relying on Value Line projections is a validly cited limitation to the sustainable growth method.
So he's saying that because investors might not even read it, you shouldn't use Value Line possibly because they won't read it in their use as they make decisions about where to invest. So just because it's not used, we should probably discount it as a methodology to use.
As a growth rate, yes.
Yeah. Okay. Okay, thank you. Well, let me ask you this. With respect to that table that Commissioner Fishman brought to our attention, no, I'm not. On page 73, the table that resulted in even lower ROEs than the other table because they were using the sustainable growth rates. Do you include those rates within your zone of reasonableness, your range of reasonableness?
I don't know. The results in that table are not the reasonable ranges that I've recommended, because those results use the sustainable growth method as a direct input into the DCF method, which I found it should not be a direct input.
Okay. I mean, there's overlap between the tables, and I
There is.
think of a range as just being the numerical bottom and top. So there's overlap between the tables. To the extent they overlap, do you think they're reasonable or not?
Yes.
Okay. All right. Thanks very much. I appreciate it. And Mr. Chair, I'm happy to take a break now. I appreciate you indulging me finishing that question because.
Oh, I appreciate you're moving through that issue pretty quickly.
Okay.
Hearing Examiner Glick, thank you for holding up to all those questions and observations. That was a lot we were throwing at you. And you handled it terrifically. We really, really appreciate you clarifying all those issues for us. And
You're welcome.
yeah, great job. And let's come back in 20 minutes. What time is it now?
3:39, 3:40.
Okay, so let's come back at 4 o'clock and resume.
Okay. Carolyn, do you know where you're going to start? On what page?
Okay, can folks hear me?
Headphones. What did I do with them?
Yes.
Okay, great. Carolyn, why don't you continue? Hopefully from here on out will be a lot smoother sailing.
Okay, Mr. Chair and Commissioners, the next topic I'm going to discuss is EPE's capital structure. This is not listed as a reduction to EPE's requested revenue requirement at the beginning of my RD because I agree with EPE on this, but it is the subject of exception, so I will discuss it. Can you still see my recommended decision on the screen?
Yes.
Okay. So capital structure is a relationship between a company's debt and equity. It influences the overall cost of capital because equity costs about twice as much as debt owing to the tax deductibility of interest payments on debt. The table here shows the recommendations on capital structure of those parties who make such a recommendation. EPE is requesting and this is for rate making purposes, a capital structure of 51% equity and 49% debt. The Attorney General and staff agree. The city and county, however, recommend a capital structure of 49% equity and 51% debt. EPE's actual capital structure for the base period ending December 31st, 2019 was 49.21% common equity and 50.79% long-term debt. EPE proposes a capital structure of 51% equity and 49% debt to reflect a known and measurable change of an equity infusion of $125 million by Sun Jupiter on September 24th, 2020. Following that equity infusion and as of September 30, 2020, EPE's capital structure was 47.93% debt and 52.07% equity.
Mr. Chair, if I could just ask a question here.
Go ahead.
So I know I already asked you, Carolyn, was the increase in that equity portion of the capital structure the reason why that infusion of capital was made? And you said, you know, there's no evidence. Is there any evidence at all about the infusion of capital in the case? Or you're just providing that as background facts? I mean, I guess it did occur after the case was filed in May. The infusion occurred in September, but what's the meaning of it? What do you do with that fact? Anything?
So if I understand correctly what you're asking, and so the base period in this case is 2019. So if you use EPE's actual capital structure at the end of 2019, it's about 49% equity and 51% debt. The importance of this equity infusion of $125 million by Sun Jupiter is that it increased EPE's actual equity ratio. And the timing is relevant because it is after the base period. And so a question is whether can you consider this because it's not what their capital structure was at the end of the base period. And EPE says it's a known and measurable change, so it's appropriate to consider that.
You say it's appropriate to consider it because the company said it was a known and measurable change? I didn't quite catch.
Okay. EPE's argument, and I agree with it, is that infusion of capital that came after the end of the base period is a known and measurable change.
Yes. I know you said it's what the test period is, and I've read it before, but I forget. The test period was also 2019?
Correct.
Okay. So what's the significance of it being a known and measurable change then?
If you consider it a known and measurable change, then you can use that as the capital structure for rate making purposes.
Okay.
If it's not a known and measurable change, then you go back to what the capital structure was at the end of the base period.
So if the company says this is a known and measurable change, does the commission have a choice about that or not?
Yes, I think you do. Well, I think you do. I think it's known and measurable. I mean, it happened. I think probably the only issue with respect to whether you can consider it known and measurable is whether it occurred too far out after the end of the base period. Because the end of the base period is December 31st, 2019. The equity infusion occurred in September 2020. So I think that might be the only reason you might not accept it. Except I'll get to the city and the county argue actually for different reasons that you shouldn't use a capital structure of 51% equity. And I can go to that if you want.
That's probably the right time to do it, unless you were going to cover it at a different time.
No, that's fine.
Okay.
So the city and the county recommend a capital structure of 49% equity and 51% debt.
Right.
Based on the capital structures of the proxy group companies and competitive industries relatively comparable to public utilities. Mm-hmm. And there's a table there that summarizes their witness, David Garrett's findings with respect to debt ratios of what they say are competitive industries relatively comparable to public utilities. So based on that, Mr. Garrett said EPE's proposed 49% debt ratio is an outlier, and if adopted would result in an unreasonably high weighted average cost of capital for EPE's shareholders. EPE's actual debt ratio at the end of the base period was not the primary factor influencing Mr. Garrett's recommendation, because he said that public utilities do not have a financial incentive to minimize their cost of capital.
Mm-hmm. Okay, so that table, oh, go ahead.
No, go ahead.
So that table is showing the debt ratio comparison. And this, and EP's proposal is 49%, and that's at a time when that was before taking into consideration that known and measurable change, right? Because 49% was their debt and 51% was their equity ratio. That, I mean, you're just referring to that ratio by the equity term instead of the debt term, correct?
Well, this table shows what EPE is asking for is that for rate making purposes, the commission find that it has 49% debt in its capital structure. Right. Whereas the city and the county recommend 51% debt.
Right, and if you were referring to their equity as opposed to their debt, and disregarding this little tiny fraction of something that I can't remember. If you're looking at their equity as opposed to their debt, the equity is just the inverse number that adds up to 100%.
Correct.
So, and with the infusion of equity of that capital of $125 million, El Paso Electric's equity portion went from 51 to 52%, roughly speaking. Correct?
It was 50.79 and it went up to 52.07. So they aren't even actually asking for as much actual equity as they currently have. Because they currently have, well, this was as of September 30, 2020, their equity ratio was 52.07. they're asking for rate making purposes that it be set at 51%.
Oh, I see. Okay. All right. Thank you. Okay. But you're saying that Garrett argues, witness Garrett argues against that because he said it would result in an unreasonably high weighted average cost of capital for EPE's shareholders to have their, for EPE's debt ratio to be 51%, as opposed to something lower, right?
Correct.
Okay, thank you.
So I recommend adopting EPE's request for rate making purposes of a 51% equity ratio. In approving utilities capital structures, the commission has relied on a utility's actual capital structure at the end of the test year period. The commission also has approved a capital structure that reflects a known and measurable change occurring after the end of the base period. I'm going to skip a little bit of this here. And I'll just conclude that EPE's requested 51% equity ratio is within the range of equity ratios that this commission has approved in litigated investor-owned utility rate cases. And it is a known and measurable change to its base period capital structure, is reasonable and should be approved.
So, Mr. Chair.
Go ahead.
So I guess the cases that are cited and at the bottom of page 35 there and top of 36 approves quite a range. And so I guess, is this similar to the reasonable range then that we had for returns on equity, a range? I mean, is there a standard beyond, you know, your description that this is within the range of equity ratios that we've approved in the past? Are you
that's my analysis. I have never heard of capital structure being talked about in terms of a reasonable range. The commission has done what is called impute a capital structure to a utility, meaning that the commission for rate making purposes adopts a capital structure that is different from the utility's actual capital structure.
They impute what? Say that again.
Okay, so the commission, this commission and other commissions have approved for rate making purposes a capital structure that is different from the utility's actual capital structure, and that's referred to as imputing a capital structure.
Yes, I've been there when we've done that. So, okay, thanks.
Are there any other questions on that, or should I move on?
No, I'm finished.
So now I'm going to go back to my recommended reductions to EPE's requested revenue requirement. And this is number 2 here. Remove from rate base major plant additions close to plant in service between January 1, 2020 and March 31, 2020. This resulted in a reduction of about $490,000. And let's see, I'll go to So the sentence here starts, while the test year period ends December 31st, 2019. I think I should have said while the base period ends December 31, 2019. EPE includes in rate base in the amount of about 4.2 million major plant additions, those over 1 million, close to plant and service after the end of the base period between January 1, 2020 and March 31, 2020 as test year period adjustments. At the hearing, EPE witness Hancock was asked the following questions related to EPE's request to include in rate base major plant additions close to plant and service after December 31, 2019. Question: now that you're bringing the additions forward, are you also making deductions from rate base for the 3 months of continued depreciation on some or all of the rest of your rate base? He responded, no, we are not. Question: and would EPE agree to move its rate base and depreciation expenses forward 3 months to correspond to its requested addition of plant going forward 3 months beyond the test period? Mr. Hancock responded, no, I don't believe we would. Question: why did the company not reflect depreciation expense for that post-test year period? Mr. Hancock responded, we do not ever project depreciation out past the test period or past the base period, but we never calculate or apply accumulated depreciation to any of the plant past the base period date or the test period date. The city objects to including in rate base those major plant additions placed into service between January 1, 2020 and March 31, 2020. In the 2015 EPE rate case, the commission did authorize EPE to include in rate base the cost of plant placed in service over 3 months after the end of the base period. The commission rejected the city's argument in that case that the plant should be included only if the net present value of the plant savings was also reflected in rate base. The commission said the city of Las Cruces has not provided a sufficient basis for the commission to depart from its practice of allowing into rate base capital projects completed within 5 months of the end of the test period and before the filing of a rate case. However, after the commission issued its final order in the 2015 EPE rate case, it issued a final order in the 2017 SPS rate case, which is relevant to this issue. In that case, SPS's test year period was July 1, 2016 through June 30, 2017. SPS proposed to include in rate base plant placed into service through November 30, 2017. SPS used November 30, 2017 balances for plant in service, plant accumulated depreciation, plant accumulated deferred income taxes, plant depreciation expense, plant timing differences, and plant deferred income tax expense. In that case, Occidental Permian Limited, or OPL, argued that the commission should disallow post-base period additions to rate base because SPS failed to reflect all the attendant impacts of the additional plant in service when calculating the impact on proposed rates, such as increased revenues from additional load. The commission rejected OPL's argument, stating, while SPS did not fully synchronize all cost of service elements to match the November 30, 2017 balance for plant in service, it did synchronize all plant-related balances, which the commission has indicated is sufficient when including test year plant in rate base. my recommendation is, under the recent precedent from the 2017 SPS rate case, EPE's request to include in rate base major plant additions placed into service between January 1, 2020 and March 31, 2020 should be denied because EPE did not synchronize all plant-related balances to March 31, 2020 in its cost of service. Are there any questions relating to that, or should I go on to the next item?
I think we're good.
Okay.
So I just had a question there, sorry.
Go ahead, Cindy.
What's the difference between, let me see. Matching, synchronizing the cost of service elements to match the balance for plant and service. What's the difference between that and then synchronizing all plant related balances? I don't understand what that is.
So in the SPS rate case, OPL argued that because SPS was including in rate base plant placed into service after the end of the base period, it should have basically used amounts reflecting that date throughout its case to match and to synchronize. And what the commission said in that case, you don't have to match all of your costs to the post base period date for the plant, but you do have to match all your plant related balances to that date.
Okay.
So let me try to rephrase it and see if this captures it, Carolyn.
Sure, I didn't explain it very well.
No, it's tough.
Yeah.
So what happens is they're valuing the new additional plants in service, a net book value as of one date. But in doing that, they're leaving everything else valued as of another date, which means that the depreciation balances don't match. They're not tied to the same date. So that if you could pick and choose what date you were going to value each asset, you'd be lost. You'd have no basis for saying at a point in time that you have an asset and a cost of owning it. So essentially it's being rejected because they're valuing assets in different timeframes when a different amount of depreciation has occurred.
I see. So really, it looks like in that case, this sentence seems to say they didn't fully synchronize all cost of service elements. Well, that's cost of service. But they did synchronize all plant related balances. So there was synchronicity in that subset of costs, I guess, plant related balances may be still different from the other cost of service elements.
Correct. And in this case, EPE did not even synchronize all plant related balances.
In which was our current case, you mean?
Yes.
So
Which is
then-
what?
Okay. Which is what?
Which is why I'm recommending that those items of plant not be included in rate base.
Okay, thank you. I appreciate this. Thank you. Sorry for taking time.
No problem. The next issue I'm going to go to is not, again, on that table at the beginning of my recommended decision as a reduction, because I did not agree with the city's request on this. Commission Rule 17.5.440.9, which I'll refer to as Rule 440, requires electric utilities to file reports before making certain extensions, system improvements, and additions. By comparing the list of plant additions in Exhibit LJH-1 to Mr. Hancock's direct testimony with EPE reports filed under Rule 440, the city concludes that EPE has filed few Rule 440 reports for the plant it seeks to add to rate base. The city asks the commission to address EPE's alleged, quote, knowing disregard, end quote, of Rule 440 and suggests the following actions. 1, deny rate base inclusion and cost recovery for any project for which no Rule 440 report was filed. 2, deny rate base inclusion in this case for any project for which no Rule 440 report was filed, but give EPE an opportunity to remedy its failure in its next base rate case. Or 3, derive a rate of variance between the projected costs in the Rule 440 reports that EPE filed and the complete project costs and apply that ratio of cost overruns or savings across the board. I found the city's suggested actions should be rejected for several reasons. First, the Rule 440 reports relied on by the city are Rule 440 reports that were admitted into evidence upon the city's motion. No evidence was admitted that the Rule 440 reports admitted into evidence are the only Rule 440 reports filed by EPE. Second, there is no requirement that the cost of plant that is added to rate base must equal the estimated cost in the Rule 440 report. Third, the appropriate remedy for any violation of Rule 440 is a fine under Section 62-12-4 of the Public Utility Act, following notice and an opportunity to respond.
So Carolyn, I'm fine with the way you decided this. I've got a question though. Is there an issue here that's worth following up on the 440s? And how would you recommend doing that, if so?
Chairman Fishman, I really don't know, because the city makes an allegation. Well, no, it does present some evidence. It says, if you compare the list of plant additions in an exhibit to Mr. Hancock's direct testimony with the 440 reports, the city says that shows that EPE has filed few 440 reports for the plant that it seeks to add. I have not done that comparison, so I can't confirm that. But assuming that the city is correct, I guess I would recommend docketing in order to show cause case, put EPE on notice that it could be subject to fines if the commission finds that it hasn't been filing Rule 440 reports as required.
Okay, thank you.
Okay.
Just to follow up though, any docket like that would not conclude before we're voting here today.
No.
And so therefore, whatever determination we might want to make about whether to not include in rate base, for example, an un-440 reported, an unreported under 440 project, if we were to do something like that, we wouldn't get to that point. Those things would just not occur.
Carolyn, I'll let you.
But that's not the remedy anyhow. The remedy, as Carolyn points out, is what's
That's
in-
exactly what I was just gonna say.
Yeah.
I think the remedy is a fine.
Yeah, I agree. Okay.
Okay, so then going back to my table of recommended reductions. It's not letting me do, oh. Okay, the next one on my list, number 6, I'm going to skip over because it makes more sense to discuss number 10 first. So I'm going to go to number 10, which is my recommendation to reduce EPE's requested rate case expenses to $1,629,259.
What page are you on, Carolyn, please?
15.
Oh. Thank you.
So that if that recommendation is approved, that would reduce EPE's requested revenue requirement by about $474,000. So now I'll go to that portion of the RD that discusses that.
And you could just announce the page number.
Yes. If you're looking at the paper copy and not the PDF, it's page 142.
Okay.
So I'll start out by discussing the applicable law because this is very important to making your decision on the requested rate case expenses. Rate case expenses are one aspect of a utility's operating costs that are recoverable in a general rate proceeding. However, under section 62-13-3B of the Public Utility Act, a utility must meet a quote heightened burden, end quote, of demonstrating the reasonableness of its requested litigation expenses. That section of the Public Utility Act states in part, in any commission rate proceeding in which the utility seeks rates to recover adjusted test year litigation expenses, there shall be no presumption that the litigation expenses are prudent. Our New Mexico Supreme Court addressed this statute in a case involving PNM. In that case, which I refer to as the PNM Gas Services case, PNM appealed the commission's denial of all recovery of PNM's rate case expenses. The Supreme Court agreed with the commission that PNM, by presenting only a budget-based estimate of its rate case expenses with no itemization of costs or evidence of reasonableness, failed to carry its burden of proving that its requested rate case expense was reasonable and prudent. Nonetheless, the court found that even if PNM failed to demonstrate that its overall estimate was reasonable and prudent, it was clear that PNM prudently incurred considerable rate case expenses. The court held that the commission's decision to deny PNM's rate case expenses in their entirety was arbitrary. Instead, the commission should have determined the amount of reasonable and prudent rate case expenses incurred by PNM. The court said the commission may utilize its own expertise and experience with amounts of rate case expenses typically incurred by a utility in a comparable rate case proceeding. This commission, in a recent rate case involving SPS, said SPS's management has discretion as to the number of outside attorneys and consultants to hire for a rate case. However, that does not mean that ratepayers must pay the cost of all those attorneys and consultants. The commission adopted staff's recommendation in that case to disallow recovery of $30,000 that SPS paid to David Carpenter, a non-testifying consultant, to advise it on cost of service and filing requirements. In denying recovery of this expense, the commission explained SPS's in-house witnesses and attorneys demonstrated at the hearing that they are intelligent and conversant with the complexities of rate case filings before the commission. SPS's local counsel is familiar with commission filing requirements. SPS did not show by a preponderance of the evidence why it was prudent to hire a non-testifying expert to assist SPS's already competent staff with cost of service and filing requirements. In this case, EPE seeks to recover estimated rate case expenses for this case of $2,401,500 to be recovered over 3 years and an annual amount of $800,500. The rate case expenses are primarily for outside consultants, attorneys, and other external costs. They do not include EPE payroll expenses. Mr. Schiestel said that EPE's requested rate case expenses are reasonable and necessary. The city and the county recommend that the commission limit EPE's recovery of rate cases expenses to 1.4 million, which Mr. Garrett said is consistent with the amount authorized in the 2015 EPE rate case. In response to a city discovery request, EPE provided the table on this page showing by category rate case expenses incurred through December 11, 2020 and estimated through case completion. So what I'm going to do now is I'm going to go through these categories of rate case expenses that were contested, for which the amounts were contested. And I'll tell you my recommendations for each of those contested categories. DCG Consulting is David Carpenter. Mr. Carpenter consulted with EPE on accounting, revenue requirement, regulatory matters, and testimony. The city and county argued that recovery of the $150,000 in expenses for DGC consulting services should be denied because EPE failed to show why it was prudent to retain Mr. Carpenter when EPE's expert witnesses demonstrated their knowledge of the issues through their testimonies, and EPE's outside and in-house counsel demonstrated their familiarity with the issues and procedures in this case through their participation. As I stated above, under New Mexico case law, EPE has a heightened burden of demonstrating the reasonableness of its requested litigation expenses. EPE presented no evidence as to why it was reasonable to retain DCG Consulting. The only evidence that EPE provided regarding DCG Consulting is Mr. Schiestel's testimony that Mr. Carpenter consulted on accounting, revenue requirement, regulatory matters, and testimony. This brief testimony does not meet EPE's burden. Sorry, that's our landline. This brief testimony does not meet EPE's burden of proving that its expense of retaining DCG consulting was reasonable. Therefore, I recommend adopting the city and county's recommendation to deny recovery of $150,000 in expenses for DGC's consulting services. Okay. The next contested category, Duggins, Wren, Mann, and Romero LLP, which I'll refer to as Duggins Wren, is one of the law firms representing EPE in this case. The city county addressed together the requested expenses for services provided by Duggins Wren and Montgomery and Andrews, both of which are law firms representing EPE in this case. EPE requests recovery of $1,350,500 for services provided by both of these law firms. The city county suggests that the commission disallow at least $350,500 of the requested expenses for Duggins, Wren, and Montgomery and Andrews collectively. They rely in part on Mark Garrett's testimony that in Public Service Company of Oklahoma's last two rate cases in Oklahoma, the utility estimated $500,000 in legal fees, and in Southwestern Electric Power Company's pending rate case in Arkansas, the utility estimates $500,000 for legal fees. Mr. Garrett further said that many utilities incur much smaller amounts for outside counsel because they use company lawyers for rate cases, which he said is a much more cost-effective approach. For example, he said that in recent rate cases, Nevada Power Company and Sierra Pacific requested no recovery for outside legal counsel fees, and Oklahoma Gas and Electric Company requested recovery of only $50,000. The city county also rely on the commission's approval of only about $1 million for outside legal fees in the 2017 SPS rate case, and the magnitude of EPE's projected expenses as of December 11, 2020, in the amount of about $593,000. In response, EPE, citing to Mr. Schiestel's direct testimony at page 40, said that it supported its request with testimony that outside counsel costs were reasonable and necessary for EPE to conduct the rate case. However, nowhere on pages 39 to 41 of Mr. Schiestel's direct testimony under the heading rate case expenses does Mr. Schiestel say anything about the reasonableness of or justification for outside counsel costs. He only makes a general statement that EPE's requested rate case expenses are reasonable and necessary. Also in response, EPE argues that nowhere in the record does any party provide evidence to strike $350,000 of outside counsel costs. EPE ignores Mr. Garrett's testimony, which I summarized. I found Mr. Garrett's testimony supports a $350,000 disallowance in EPE's requested approximate $1.35 million for outside counsel expenses. I said, in fact, given the paucity of testimony that EPE provided regarding outside counsel services, the disallowance could be more. However, given my observation of outside counsel's work during the hearing, a $350,000 disallowance is reasonable. The next challenged rate case expense is for the law offices of Randall Childress. Mr. Childress consulted with EPE on accounting, revenue requirement, regulatory matters, and testimony. The city county argued that recovery of the $16,676 in expenses for Mr. Childress's services should be denied because EPE failed to show why it was prudent to retain Mr. Childress when EPE's expert witnesses demonstrated their knowledge of the issues through their testimonies, and EPE's outside and in-house counsel demonstrated their familiarity with the issues and procedures in this case through their participation. Again, I'm repeating myself as stated above, EPE has a heightened burden of demonstrating the reasonableness of its requested litigation expenses. EPE presented no evidence as to why it was reasonable to retain Mr. Childress. The only evidence that EPE provided regarding Mr. Childress is Mr. Schiestel's testimony that Mr. Childress consulted with EPE on accounting, revenue requirement, regulatory matters, and testimony. I found this brief testimony does not meet EPE's burden of proving that an expense of retaining Mr. Childress was reasonable and that the city county's recommendation to deny recovery of that expense should be adopted. The next challenged rate case expense is for Management Applications Consulting, Inc., which performed the loss study presented by EPE witness George Novella. Mr. Novella said that EPE commissioned, I'm calling Management Applications Consulting, MAC, in November 2018 to provide an updated system-wide loss study conducted by MAC in April 2019 using calendar year 2017 data. As of December 11, 2020, EPE had paid $2,625 to MAC, and the estimated cost to completion was $72,375. The city and county argue that it is inexplicable that most of the expenses for MAC's services had not been paid as of December 11, 2020, given that MAC conducted the study in April 2019. They also argue that EPE has not shown that the loss study was not used for purposes besides this case, such as for operating reasons and for EPE's upcoming public rate case in Texas. Therefore, they argue that the commission should disallow recovery of the entire $75,000 requested amount. EPE did not respond to the city's specific recommendation for disallowance of expenses for MAC services. The study is Schedule M3 to EPE's application and consists of 51 pages. The title page of the study says that the study's final date is April 18, 2019. The city is correct that it is inexplicable that most of the expenses for MAC services had not been paid as of December 11, 2020. The study was prepared before the commission extended the July 31, 2019 deadline for EPE to file its rate case, and EPE obviously did not need to have this study redone because it attached the study to its application in this case, the 2019 study. EPE may argue that it has been deprived of an opportunity to develop evidence on this issue because the city raised it for the first time in its initial post-hearing brief. I concluded what EPE fails to recognize is that it has the burden of proof in the first place to justify recovery of its requested rate case expenses. EPE has failed to show when it paid $2,625 to MAC and why it was necessary to pay MAC $72,375 after December 11, 2020, when the study had been completed and was presented by an internal EPE employee. Therefore, I recommended that the city county's recommendation to disallow recovery of $75,000 for MAC services should be adopted. The next challenge expense is for Montgomery and Andrews, one of the law firms representing EPE in this case. As I've already explained, I recommend a collective $350,000 disallowance of EPE's requested recovery of about $1.35 million for the services of the two outside law firms. The next challenge expense is the Wilson Consulting Group. Scott Wilson of Wilson Consulting Group consulted with EPE on accounting, revenue requirement, regulatory matters, and testimony. The city and the county argue that recovery of $50,000 in expenses for Mr. Wilson's services should be denied because EPE failed to show why it was prudent to retain Mr. Wilson when EPE's expert witnesses demonstrated their knowledge of the issues and its counsel demonstrated their familiarity with the issues and procedures in this case. My recommendation regarding this is the same as my recommendations to disallow recovery of David Carpenter's fees and Randy Childress's fees because the EPE again provided the only testimony they provided regarding this expense is Mr. Schiestel's testimony that the Wilson Consulting Group consulted with EPE on accounting, revenue requirement, regulatory matters, and testimony. And finally, the last challenge cost is other costs, which EPE identified as mailing, meals, and travel for hearing. As of December 11, 2020, EPE had incurred $1,844 for other costs. All witnesses and attorneys in this case appeared at the hearing via the Zoom video conference platform. When asked why EPE expected to incur another $130,565 for these expenses, Mr. Schiestel said that this estimate was based on EPE's actual costs for those expenses in its last rate case. When further asked whether he believed it would actually spend that amount, Mr. Schiestel said, "That's our estimate, yes." The city and county recommend that the commission deny recovery of $130,565 for other costs, given the cost savings resulting from holding the hearing via Zoom and the commission's adoption of electronic filing. EPE did not respond to the city's specific argument and the city's recommended disallowance of other costs. I found the city's argument is compelling. Why does EPE have any costs for mailing, meals, and travel for hearing, given that the hearing was held through Zoom and that the commission adopted electronic filing? EPE may argue that it has been deprived of an opportunity to develop evidence on this issue because the city raised it for the first time in its post-hearing brief. Again, what EPE fails to recognize is that it has the burden of proof in the first place to justify recovery of its requested rate case expenses. So I recommend approval of the city's recommendation on that issue. So the total of my recommended disallowances is $772,241. Taken from EPE's requested rate case expenses, this leaves about $1.6 million in recoverable rate case expenses. Okay.
Wait, Carolyn,
Yeah.
maybe I'm getting tired here, but if you're going to disallow $700,000, almost $800,000, and you take it from their requested expense amount of 1.4 million, it doesn't leave 1.6 million.
Oh, you're right. you're right, that's a mistake. But I think what I said in the recommended,
Let's just mean, maybe that one is a typo. It's just 629,000 left. That might work.
let me check that. Oh my,
Well, if Carolyn made a mistake, then my mind is blown because I've never known Carolyn to make a mistake.
ask my husband. Nothing.
Yeah, that in the figure 1,629,000, et cetera. The one is just a typo. It shouldn't be there.
No, let's see.
If you add up
Maybe
772 plus 629, et cetera, you'll get exactly 1,401,500.
okay, what's wrong? What's wrong is the one should be a 2. So EPE's requested rate case expenses are 2,401,000. Okay.
Thank you.
Good catch, Cynthia, I said.
Just a number nerd.
I should say Commissioner Hall. Excuse
Oh, it's
me,
okay.
too informal.
This time of day, it doesn't matter. How late are we going today? It's 5 o'clock. I mean, oh, we should go to the end. Is that what our plan is?
Well, Carolyn, how much time do we have? How much more time do you think we need to go through today? What do you have left?
Finish? To finish my presentation?
Yeah,
Oh boy, a couple hours. I mean, there's a lot left. So I'm still going through each adjustment I recommend to EPE's revenue requirement. And I have 1, 2, 3, 4, 5, 6 remaining plus one more that's challenged in exceptions. And then after that, I have to discuss allocating the recommended rate decrease among the classes, my recommended standard rates, my recommended time of use rates, the issue of the Palo Verde proxy price. There is a lot left. There's a couple more issues left.
so does this mean we need to add extra time to what we've already got scheduled for you?
Mr. Chair, can't we just do it the next, I thought we had 3.
Yes,
Hearings.
Mr. Chair, I think Russell can, or
Yes.
someone can, we
Mr.
have this
Chairman.
divided up.
Yeah, commissioners, we do have Tuesday. I guess we're going to be having the open meeting next Tuesday, June 15th at 10 a.m., I think. So I think there's plenty of time in there. I was planning on having the RD presentation broken up. If you want to go another half hour, that's fine, but you don't have to. I think there'll be time for that. And then next week, the rest of the RD will be presented. I don't think anything's going to take as long as ROE, except maybe time of day rates. But then I'll be presenting the exceptions, but of course we'll have talked about the subject matter of the exceptions anyway, and I'll be presenting final order. But like I said, that'll be all wrapped into what Carolyn's already talked about. So it'll be a long session next Tuesday, but we have time.
Okay. So commissioners, worn out, or should we go another half hour?
I say we break for the day. That'd be my preference.
Me too.
Okay, I think we're all getting a little bleary-eyed. And once again,
I'm still really excited about it.
That a
I
girl.
said, this is Michael Smith. I think we should actually get the large hook that just reaches out and pulls Carolyn.
As if the performance is bad. It's not.
I just want to get Carolyn a huge green eye shade for just her ability to go through all these numbers. So you're an honorary official accountant. But man, okay, so let's break for the day unless any commissioners have an objection.
Oh,
Hearing none,
man.
we're done with this portion of the meeting. And thank you, Carolyn. Great job. And we're going to go on to the next item on the agenda and wrap things up. And the next item on the agenda is communications with Chief of Staff. And Wayne, are you here?
I'm here, Mr. Chairman.
Oh, terrific. Great to have you back.
Thank you. It's good to be back. And I'm not going to get in the way of you all and dinner or going to the gym or whatever you've got planned. So I'll, if it's okay with you, Mr. Chairman, I really don't have a lot to update you on. Maybe I'll just do want to update you on the Bochum building, but I can do that via email.
Okay, thank you, Wayne. You read this commission well.
That's a long day. That's a long day.
Commissions with communications with General Counsel.
Just wanted to say the hook comment was just a joke. Carolyn does a great job, and I would have suggested that she would be the employee of the month, but she was it for like 2.5 years straight. So.
Oh, okay. Well, so we can still use the hook, but we can just use it to pull her back into the meeting.
Exactly.
There you go.
So I'm done.
Any other issues?
No, that's it.
Okay. And communications with commissioners. Any commissioner thoughts?
Next week, I'll bring an issue to the commission's attention having to do with the filing of FERC. I think I mentioned before, related to California ISO's summer readiness filing. I talked about it once, but there's more information to talk about, but I can talk about it then.
Okay. I'll make one quick comment. We had APE's presentation about their worries about the summer shortage.
You had a what?
EPE our last meeting presented on their concerns about
Oh, yes.
power outages and blackouts during the summer. I've heard from constituents that PNM has set out notices to the same effect to their customers that they might be faced with blackouts. And of course, now they're asking for a lot more capacity, or they haven't asked, but they've sent out an RFP. And I'm wondering if the commission should start asking for information about exactly what steps utilities will take for the summer should they face blackouts and shortages.
Well, Mr. Chair, we did have PNM come in and present about what their plan would be. And you even asked for some deliverables from their representative. So we did that part. I can't recall whether that happened with any of the other utilities.
Well, so I just wanted to.
But we need to get more specific information. I agree.
Yeah, so I just wanted to say, that I've got Robert putting together, and I put together, got him started, some questions that we should ask to be specific so that if that happens, we're not catching up. We know what it is they've tried to do. They've given us their plan, and there are various steps that they might or might not take. So I just wanted to alert the commission that I'll probably bring that forward at the next meeting.
Yes, that's great. And that's consistent with what my concerns are too. I think we do need to regularize what we want to hear from the utilities in a series of questions. But I might as well just tell you, it doesn't take that long, what I was going to say next week or postpone. I received a letter, and I thought it was sent to all the commissioners, from Doug Howe on behalf of I forget the name of the group, but it was a group of 4 entities. WRA was one of them. And there were several utilities, I think, and they had as a group filed at FERC their comments indicating their concern about the contents of CAISO's filing before FERC. And they are not alone. As I think I mentioned the first time, there are numerous utilities and other types of entities throughout the West have filed in that docket, as have other commissions. And Dr. Howe was suggesting that we take a look at creating a filing ourselves. And so I was going to take some steps to go forward on that and maybe try to bring a draft to the commission. I don't know if I'll get that done in 1 week. The filing deadline has passed, but I've seen that several parties, including this group that Dr. Howe is representing, I guess I should say Commissioner Howe, former Commissioner Howe, filed a request to file their comments at a time, and they're accepted. So we could still file, I believe. So that's what I was going to say. And I'll proceed on that unless somebody wants me not to.
Any other communications from commissioners at this?
No.
Okay, we're going to adjourn.
Mr. Chairman, Michael Smith.
Thank you. Go ahead, Michael.
I just wanted to remind you, we do have a meeting tomorrow on the New Mexico. It's the hearing on the New Mexico Gas Company case, 2196.
Correct.
It's tomorrow morning, right, Mike?
That's correct. 95, I'm sorry, not 96.
What?
It's case 21-00096.
Right.
95.
Making the same mistake over again.
Okay.
Okay. With that, we're adjourned. Thank you, everybody.
Thank you.
See ya.
Bye.